going to take a big loss like we've seen in some of these past races, say in Georgia or Pennsylvania in the past with Donald Trump endorsed candidates. So either Donald Trump is getting better at his picks, or, the candidates themselves are wising up. He's really untested in this regard, but I think Donald Trump had a very good day yesterday in terms of his endorsements. And I would say the losers here are number one, the polls, which really showed a much tighter race than we got. And number two, moderates in the Republican Party. I mean, if anything is clear, that they cannot make it in the current MAGA-controlled Republican Party. And that's really where the party is headed for the next at least several months, if not year.
Well, Rick, we were discussing the idea of the Trump endorsement and Trump-backed candidates and how they perform in general contests versus primaries on the evening edition of Balance of Power last night. And something that was brought up was we saw what happened to a number of Trump-supported candidates in the midterms in 2022. But a difference that was raised is that Trump wasn't at the top of the ticket in 2022. He will be in 2024, together with all of these down-ballot candidates. How does that make a difference in this cycle?
Yeah, I think that we're in an era right now where all politics is national. We used to say, all politics is local, and how you vote for your member of Congress is different than how you would pick a president. And that doesn't exist anymore. I mean, that just practically speaking was yesterday's news. Today, Donald Trump is at the top of the ticket, and he will drive the Republican ballot all the way down to sheriff. And so I think that what we're going to see is in states where Donald Trump wins, and Ohio is certainly a good example, he's going to drive down ballot races, and they're going to get pretty much what we think Donald Trump's going to get. And so that actually helps his down ticket candidates because he will actually drive turnout. I think that, and this is another good example, the race you were just talking about, Marcy Kaptur, that's a district that Donald Trump won. And you got a Democrat sitting on the House seat there. So is Marcy Kaptur going to be able to get enough ticket splitters who are going to definitely vote for Donald Trump? And that district's not going to change again. It's not going to be a Biden district. And is she going to get enough to be able to outweigh that influence from the top? If I were a betting man, I'd say in districts that Trump are going to win, the House member is going to win too, and that puts her in jeopardy.
Trying to figure out who is going to replace Kevin McCarthy in California. And last night did not go very far to helping us understand that. This was, I guess, the tough spot of the night for Donald Trump, Jeannie. Representative Vince Fong, state representative, not only endorsed by Trump, but also McCarthy himself is going to a runoff. What does that tell us about that district? Is it just too crowded? Is there more at work here?
Yeah, I mean, he lived to fight another day. It's obviously not the outcome they wanted. I think in the end, he probably does come out okay in this. But, I think it does show that there are some limits to these endorsements. And, in that case, as you mentioned, you had the presidential nominee, and you also had the previous seat holder in Kevin McCarthy. And so between the two of those, you would think they cover all the bases. It didn't happen in this case. And so he's going to have to fight this for the next, few weeks or months.
Shortly expecting results from the Fed reverse repo facility.
I know to this point we've largely talked about the primaries yesterday as only being significant for what it told us about all these different down ballot races, but it's also worth noting that while Trump and Biden won all of their respective primaries, Trump was polling 70 to 80% of the vote, Jeannie. People were still out there voting for Nikki Haley and Ron DeSantis, who have suspended their presidential campaigns. How significant is that?
It is significant, and I'm so glad you raised it because it doesn't get talked about enough. One of the questions we hear was how many of these votes were early. Well, increasingly fewer. And so what we are seeing is there is in the Republican Party a never Trump or Trump alternative voters. The question now is, do they come home again in the end in November? But so far, they do want to have these protest votes because they are supporting
78
people who
counterparties
simply
take
are not on the ballot. And you look
$496.245
at
billion
the
at the Fed Reverse.
Democratic side, and Joe Biden
So again, that's at
is,
the Fed Reverse
pulling
Repo operation.
80-90%, so 9 out of 10 voters in many cases. So he is not getting that similar, anti-Biden vote that we have been worried about as it pertains to issues like Israel and Palestine, for instance.
Rick, we're going to be hearing from Jay Powell a short time from now. Our special Fed coverage starts in about 15 minutes here on Bloomberg TV and radio. Of course, the announcement will come at the top of the hour. And then there's going to be a conversation with reporters that will generate the headlines that produce the stories that Americans are going to be reading at Bloomberg.com, on the terminal, and elsewhere. This is key to Joe Biden's potential success, his success or failure on the campaign trail coming up here. What are you going to be listening for from a political standpoint when Jay Powell talks a short time from now?
Yeah, I mean, obviously, if you're sitting in the Biden campaign, you're looking for what is the quote that I want to retweet that's going to make it sound like the economy is out of danger of a recession, or coming out of a recession, or the rates are going to come down to the point where you can make some kind of political hay with it. I mean, so much of Fed speak gets lost in the political rhetoric that it's sometimes very hard to find anything that you would point to that would be sellable politically. Powell has an incredible, uncanny ability to not make news. And so I think that's going to be the challenge for the Democrats. They desperately want to continue to convince voters in America that Biden's stewardship of the economy has been effective, and that the Fed is going to start to, lower rates based on the success of the Biden fiscal plan. And there may not be anything that they can really tout today, and that'll be a disappointment for the Biden campaign.
Rick Davis and Jeannie Shanzano, our signature panel here on Balance of Power. Great conversation. Thanks to both of you as we work our way closer to the Fed decision today. A conversation next with Mark Zandi, the chief economist at Moody's Analytics. I guess we could call him a dove. Kaylee, he thinks the job might be just about done.
Yeah, we'll see if Chairman Powell doves today. This is Bloomberg.
Top names in climate finance.
ECB's Nagel says the ECB is continuously getting closer to the 2% inflation target.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Access the financial world on
So in 10 minutes time now, at the bottom of the hour, we see the release of the Bank of Canada's meeting minutes.
Economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars. Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
It's 1:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got the FOMC rate decision coming up at 2 o'clock Wall Street time. Complete coverage on Bloomberg television and radio. And then 2:30 p.m. Wall Street time, Fed Chair Jay Powell's news conference. We got it live on Bloomberg television and radio. Right now, stocks are virtually flat on the day, looking at a 3-point drop in the S&P 500 index, now at 51.75, down less than 0.1%. Dow Industrials unchanged on the day. NASDAQ, the composite index, down 10, drop there of less than 0.1%. Fed Wednesday, the 10-year 4.2%, with a 2-year 4.67%. Gold flat on the day, down 75 cents the ounce to $21.56. West Texas Intermediate crude oil down 2.1%, $81.69 a barrel on WTI crude. Bitcoin now higher by 1.1%, 64,474 on Bitcoin. The U.S. will be awarding Intel $8.5 billion in grants and as much as $11 billion in loans to help fund an expansion of its semiconductor factories. Intel shares, they are now lower by 1%. We've got AMD down 3.8% and NVIDIA lower now by 1%. Again, recapping, stocks lower, S&P now down 3 points, little change, down less than 0.1%. Balance of power continues. Back we go to Washington. Once again, your hosts, Joe Matthew and Kaylee Limes.
All right, Charlie Pellet in New York, thank you so much. Welcome back to Washington, D.C., where just about a mile or so down the road, Federal Reserve officials are huddled, waiting to release their decision just about 35 minutes from now. And Chairman Powell probably doing his deep breathing exercises before he has to go out to the podium and not only defend the decision and whatever we get in the summary of economic projections and the dot plot, but face the questions of journalists who desperately want to know, along with pretty much everyone else, when this Fed is thinking about cutting rates and how much they intend to do so.
Yeah, it's a good opportunity to talk with Mark Zandi. We're going to be in our special Fed coverage in less than 10 minutes here. Mark, of course, chief economist at Moody's Analytics. Wanted to get a sense of what Mark had in mind before we turn things over to New York. Mark, the economists surveyed by Bloomberg News are factoring in 3 cuts here for 24, the first to begin in June. Will that expectation still be intact after today's meeting?
Well, Joe, yeah, I think so. I think that's going to be Chair Powell's intent, is to make sure that everyone knows that 3 rate cuts are coming. At least that's the most likely scenario, and that hasn't changed from the last meeting. So, yeah, I suspect he'll want to send a message that things are on track here for 3 rate cuts as the year comes to an end.
Well, and when Chairman Powell takes the podium, as I said, obviously he always is trying to walk that line where he doesn't really want to make news.
In 5 minutes' time now, at the bottom of the hour, we see the release of the Bank of Canada meeting at minutes.
If Chairman Powell had the capacity to surprise today, do you expect that surprise could come in the form of being more hawkish or more dovish than expected?
Well, Kaylee, I think at times he does want to surprise markets, and he wants to push markets in a certain direction if he thinks so-called financial conditions are not to the right side of where he thinks policy should be or is headed. So I don't think he's shy about doing that. I don't think he wants to do that today. I think, financial conditions, when I say that, I mean stock prices, of course, they're high. Credit spreads in the bond market, of course, they're thin. But we also have very tight lending conditions in the banking system. The value of the dollar is very strong. Mortgage rates are high. So you kind of take all those things together. Conditions are, I think, about right where he wants them. So I don't expect him to want to make news today. if I had to take one side or the other, I suppose he'd still be a little bit more on the hawkish side than on the dovish side, meaning sending a signal to markets that this may take a little longer than June for them to start cutting interest rates, only because the inflation statistics over the past couple of months have been hot. They've been on the high side. But, I'm stretching. My sense is here, this is one of those meetings where you're right. He doesn't want to make news.
Mark, when we talk to President Biden's economic advisors, they will not touch the Fed. It doesn't matter who it is or what council they're on inside the White House. The Fed is independent, and we're not going to go there. How closely are they listening to the nuances in that news conference today?
Well, Joe, and that is as it should be. I mean, one of the bedrocks of a well-functioning market economy like our own is a independent Federal Reserve, and that's going to be really key, here as we move to the presidential election. That is really important to maintain, because you need a Fed to be able to respond to whatever lawmakers are doing or not doing in Washington. And so that's really, really important. But, I'm sure they're hoping, like most Americans, that, rates are going down, that we've got inflation back in the bottle or headed in that direction, that the economy's at full employment and, feels like the Fed has met that objective, and that it's time to cut interest rates. And, it's not going to be this month. It's probably not going to be in May, but hopefully by June we start seeing lower interest rates, and that will have a benefit to particularly lower income Americans who took on a lot of credit card debt and consumer finance loans, home equity lines. I mean, they're tied right to what the Fed's doing. So I think they'd be looking for hopefully rate cuts later this year.
Well, especially, Mark, as you talk about the lower income brackets of the American population, we have started to see things like delinquencies ticking up. And I know you were just talking about the idea of full employment. This White House continually is touting the strength of the labor market, and it has sustained that strength to this point. But are you starting to see real cracks that you're paying attention to, that you think the Federal Reserve might be paying attention to when they're assessing whether or not policy needs to start easing?
Yeah, I think more, not in consumer credit. I mean, actually, I think the worst is over there, Kaylee. I mean, I think with rates coming in, with lenders tightening underwriting in the wake of last year's banking crisis, and just the fact that inflation has come back down and is now well below the rate of wage growth. So people's purchasing power is improving, and that's across the wage distribution, high wage and low wage. So we're starting to see, I think, the worst. At this point, we're seeing the worst of the credit problems in, 3-6 months from now. If everything kind of sticks roughly to script, we'll see better delinquency rate numbers. But I think the thing that makes me a little nervous, and, I heard you call me a bit of a dove. And by the way, I can swing both ways, no problem.
1 minute remaining for the Bank of Canada meeting minutes.
No problem. But in this case, I'm a bit of a dove because I worry, sounds a little odd, but I'm uncomfortable with what's going on in the labor market. It feels softer to me than the headline numbers, the job growth we're getting each month. You look at the number of hires, they've come way down, across almost all industries. You can see hours worked being cut relative to where we were, and pretty low by an historical standard. Job openings, they've come way in, quit rates have come way in. The announced layoffs are high. I mean, I know layoffs are low, but it just feels like we're starting to see more companies start to announce layoffs, and that could show up in the actual unemployment insurance claim. So the bottom line point is, it just feels like the economy, it's resilient, it's strong, but there's some
10 seconds
here. And the longer rates stay where they are, I think that poses some risk, to the economy. And to what end? I mean, we're at full employment. In my view, inflation is.
So the Bank of Canada Council expressed concerns that the housing market continued to pose upside risks to the inflation outlook, according to the minutes. They agreed that underlying inflation is not measured by a single statistic, but rather by a collection of indicators. Indicators of underlying inflation suggest slow progress getting inflation down to target. Bank of Canada Council members also had differing views on how to weigh the risks to the inflation outlook. Again, had differing views about when there would likely be enough evidence to judge whether conditions for cuts were in place.
So why do we need a 5.5% funds rate when?
So the Governing Council agreed conditions for rate cuts should materialize this year if the economy evolved as forecast. January pressures were not caused by quantitative tightening and therefore did not indicate a need to change the bank's approach. So the council noted that market pressures on the overnight rate that were seen in January had mostly eased, and that strength in the Canada and US equity markets could provide a boost to consumer sentiment.
Indeed.
Recent
Tips
housing
from Mark
market
Zandi,
data
Movies
suggests that
Analytics.
shelter
Thank you
price
so much, Mark,
inflation
as
is
always,
likely
for
to
joining
remain
us
the
here
biggest
on
contributor
Bloomberg
to total
Television and Radio.
CPI
We have just
inflation,
about
according to
30
the
minutes
minutes.
to go on this.
So
Of
while
course,
house
it's
prices
not just the
continue to
decision.
fall
We
in
basically
January,
know what the
recent
decision will
strength
be.
in
They will move
resales
rates
could
on
translate
hold.
into a pickup
It's
in
in
house
everything
prices
else
and
and
stoke
in the
shelter
words of
price
Chairman
inflation,
Powell
according to the
at that
minutes.
press conference.
And they saw nothing in the data that would change their view that CPI inflation will remain around 3% in the coming months. So again, that was just the release of the Bank of Canada's meeting minutes for their March 6th meeting.
Is that true? I'm not sure he follows that.
I don't
have
think
to talk to Michael about that later. He's going to join us, by the way, in the later edition of Balance of Power that starts at 5 p.m. Eastern Time. Kaylee and I will be there live here from Washington, where that Fed decision is imminent. I'll meet you then.
Sounds good.
Here on Bloomberg TV and radio, a special decision of Bloomberg surveillance. The Fed decides straight ahead.
Morning, this is Bloomberg Daybreak Europe. I'm Tom Mackenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Live from New York City for our audience worldwide, Bloomberg's The Fed Decides starts right now.
Special edition of Bloomberg Surveillance with Tom Keene, Jonathan Farrell, and Lisa Abramowitz. Bloomberg Surveillance, the Fed decides.
Counting you down to another Fed rate decision and Chairman Powell news conference. That is 27 minutes away. That decision just around the corner. Alongside Lisa Abramowitz, I'm Jonathan Farrow. Your equity market on the S&P 500 going absolutely nowhere, close to all-time highs going into this one. Bramo, statement, news conference, projections, and maybe a conversation in the mix on the balance sheet.
Maybe, and maybe that won't necessarily be the front and focus, especially if Jay Powell does what he usually does in the press conference, which has a dovish tilt. And that's sort of what people seem to be geared up for at a time where potentially some of the hotter than expected data could cause something of a different kind of surprise.
I think we have to begin with what this meeting was meant to be 3 months ago. 3 months ago, looking at 3 months, this was meant to be the meeting this Federal Reserve started to reduce interest rates. It's not that meeting anymore. In fact, we're trying to work out.
We have also posted out the link to the full Bank of Canada summary of deliberations on the feed for anybody interested.
What data matters to them, how they interpret some of the hotter than expected CPI and PPI data, whether they're taking a look at an economy that the stock market is saying is rip-roaring hot, and they're saying it's going to cool more substantially. Do they give us any hints, given the fact that basically they're saying we want to cut, we don't know what's happening, we have patience to wait? Is it going to be a snoozer, or are they going to drop a bomb?
So that was the last event today ahead of the headline events of the day and the week, being the interest rate decision and the FOMC's release of the summary of economic projections and the rate statement as well. So this is in just over 25 minutes time now at the top of the hour. Just as a reminder as well, a little later this afternoon at 2:30 p.m. Eastern Time, we see the FOMC press conference with Chair Powell.
On a 10-year, 427.48 on 10s. On a 2-year, Bramo, we're down about a single basis point to 467.
No drama, but I will say what we do have drama with is some of the best and brightest coming and talking with us. Coming up right next to us, Mohammed El-Arian of Queen's College, Cambridge. He'll be joining us throughout the hour. Then Kathy Jones of Charles Schwab and Deutsche Bank's Matt Lazzetti will be taking us up to the Fed rate decision at 2 p.m. It'll drop, including the statement of economic projections. We'll get immediate reaction.
So for anyone interested, we have just published again the US interest rate prep article made in-house by ourselves. So this does have some investment bank views as well as an overview of the situation surrounding this US interest rate. So again, that's on the feed for anybody interested.
Jeff Rosenberg's incredible insights, John. Really, this is
so we will be going through a little closer to the time some of the investment bank views inside this article.
Queen's College, Cambridge. Mohammed, great to see you. Do you think we're injecting a little bit too much excitement into this one, or is this the real deal? One to watch?
It's not one to watch in terms of getting any actions. It is one to watch in terms of signals, but it is particularly one to watch with respect to the press conference, because Chair Powell is going to have to decide what tone does he take at this particular moment. And does he repeat his performance in front of Congress, which is maintain a very steady course, or does he impart significant volatility into the marketplace as he's done in previous press conferences?
We should mention that semi-annual testimony was only in the last few weeks. Has that much changed with a hot PPI report and a hot CPI as well, or at least hotter than expected?
At the margin, yes, but not enough for him to surprise the market. What I find fascinating is all the questions you've raised, Lisa. This is supposed to be a very transparent Fed. This is supposed to be a data-dependent Fed, and yet all these questions have arisen. And I think that we're looking for spurious accuracy. And in the dots in particular, there's going to be spurious accuracy. You know, it doesn't take much to go from 3 to 2 cuts, and yet the market will probably amplify if that happens.
Amplify means sell off, right? Is that what you're saying? Amplify means that basically if they go from 3 to 2, you get sort of a sell-off in bonds and stocks as people reassess just the willingness of the Fed to cut in the face of hotter than expected inflation data.
That's probably what's going to happen. It shouldn't happen. This is really spurious accuracy. We should say 2 to 3 cuts starting in June, July. But to go beyond that right now is going to be very difficult.
Do you think that it is the correct policy of the Federal Reserve not to update their long-term neutral rate at a time where this is ultimately one of the biggest questions? Where are you cutting to at a time where it does seem like inflation is a bit more embedded than it was pre-pandemic?
So they should be doing it, but this is not a strategic Fed. This is an excessively data-dependent Fed. So they are not very keen on embracing this whole forward-looking, what is the equilibrium rate, et cetera. So we're not going to hear much about that this time, but we will hear a lot about the data. I'm most interested in what do they do with their PCE projections. Do they leave it at 2.4 for core headline, or do they take it up? That's the one you should look at.
We've got to gauge his confidence as well. We know he was getting a little bit more confident, but looking for more confidence. This is how ridiculous some of this has become. Do you think, based on the data we've had over the last month, that he has lost confidence, gained confidence? Which one?
So if he is consistent with being so data dependent, he should have lost some confidence. We've had 3 hotter than expected inflation prints. That tells you something. But if he were to look forward,
ECB's Nagel says, I'm more worried about Europe being the sick man than Germany.
How quickly should you get to 2%? That is why his press conference is going to be so
Every
delicate.
time we bring this up, you mention this point. You think they should push out the timeline for this, don't you?
I do.
By how long?
By a couple of years.
You think it's going to be that difficult to get back down to target?
Yes.
Why?
Because we're living in a world where the supply side isn't flexible enough. And you get almost every week you get indication of changing supply chains. You get indication of the tightness of the labor market. You get indication of an energy transition that's not going as well as people wanted. All these things mean the supply side is less flexible, and the underlying inflation rate that is consistent with economic well-being for now is somewhat higher than 2%.
Do you get the sense they see it the same way on the FOMC?
We don't know because they don't speak about longer-term issues. They tend to be so data-dependent. And remember, the data dependency issue is that you're driving a car looking through the rearview mirror. The other thing they tend to be, and we saw that very clearly in December, is that they tend to be influenced by markets. You know, John, I had this image that the market goes on a roller coaster, and the Fed's role is to be looking at the roller coaster, not being in the roller coaster. However, the Fed has tended to be influenced a lot by the market's roller coaster.
Well, at this point, it doesn't sound like they have. If in December they weren't pushing back against some of the enthusiasm we started to see in markets, they basically turbocharged it. Will they be taken on that roller coaster and try to tamp down some of the enthusiasm that we've seen with equities making all-time highs?
So remember, December market was pricing in 7 cuts for this year, and Chair Powell surprised everybody by a very dovish pivot. If he is to stick to that, now the market is pricing just less than 3 cuts. Does he pivot more hawkish? That is the problem they're getting themselves into if they are too overly influenced by what's been happening in the market and by the data. You should take that into account. It should inform and influence your decisions, but it shouldn't impose on what you say.
When you say that this is a very data-dependent Fed, what data are they looking at? We keep talking to people about the choose-your-own-adventure nature of this data. Do we have a sense of what has more import to them than other indicators?
So they've told us they look at different variants of inflation where they take out a few things that they think we shouldn't be looking at or that are distorted. So they do look at that. They certainly look at the labor market, and they look at not only what's happening to wages, but also other indication of the tightness of the labor market. And they do look at what's happening to the economy as a whole. So I do think they are very, very overly influenced by the backward-looking data. And they do take a holistic view.
A question that Lisa and I have asked a million times over the last month or so. I want to ask it again of you. Biggest risk right now, based on what we know, just based on what we know so far, what is the biggest risk? Waiting too long to cut or cutting too soon?
This Fed the biggest risk it faces is of being overly tight and pushing this economy into recession when there's no reason for it to go into recession.
So holding too long.
Yeah.
How would you define holding too long? Going beyond June? Going later this year?
Going later, not doing 2 to 3 cuts, being hawkish. You know, it's a different Fed. Entering into this inflation shock that they got, they tended always to be on the dovish side. The inflation shock that they got has reminded them of the 70s, and that's something they do not want to repeat. So the balance of risk, if they're wrong, is that they're too tight rather than too loose.
Interesting, because Lisa, that conflicts with some of the other things we've heard from, say, Steve Rasciuto of Mizuho, who thinks that they're itching to cut interest rates, just the economy and the economic data won't cooperate.
Which is part of the problem that some people are looking at with some of those base effects of transition to different kinds of technologies. When it comes to nearshoring and rejiggering supply chains, all of these inflationary impulses, how does a Fed counter those while not torpedoing the economy? Which do they prioritize? What we're hearing is the labor market takes precedence, and that seems to be where a lot of people seem to be leaning, including Jay Powell.
I just wonder whose argument wins on the FOMC today. And we can talk about this through the afternoon. Governor Waller, who's kind of saying, what's the rush? President Kashkari, why do anything? Given the economic data we've had, I just wonder if the Hawks win that argument on the FOMC going into this decision in about 18 minutes' time. Mohammed's going to be sticking with us. Coming up very shortly, we'll catch up with Kathy Jones and Charles Schwab alongside Deutsche Bank's Matt Lazzetti. Your equity market on the S&P 500 negative here by 0.1%. In the bond market, yields just a touch lower, 467 on a 2-year, on a 10-year, 428.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Very close to all-time highs going into this Fed decision. Equities pulling back just a little bit. We're negative by 0.1% on the S&P 500. On the NASDAQ, down about 0.1%. In the bond market, some decent moves over the last week or so. Yields repricing higher. At a front end, the low of the year in January, 4.1% over the last week, back through 470. Lisa, on a 2-year right now, 467.
People really pricing out the idea of more than 3 rate cuts this year. Now it goes over to the Fed. Do they say, you know what, you are correct, market, and we are actually leaning toward maybe 2 rate cuts rather than 3? Does it have a material sell-off effect?
So we're just under 15 minutes away now to the top of the hour, where we do see the release of the US interest rate decision, alongside the FOMC summary of economic projections and the rate statement as well. So it's taking a look at some commentary from some investment banks ahead of this release.
Absolutely dominant.
So looking to a note from Nomura, they note that they expect a hawkish update to the summary of economic projections at this coming meeting. The year-end inflation forecast for this year should move higher in the wake of the 2 months of upside surprises. So in Nomura's view, it is more likely than not that the median dots move higher for this year and next year, which is consistent with their own monetary policy outlook. In addition, Nomura expect the average of longer-run dots to move up, while its median likely remains unchanged.
Away from that decision. Joining us is Kathy Jones of Charles Schwab and Matt Lazzetti of Deutsche Bank. Kathy, got to begin with you. How are the summary of economic projections going to look at 2
So again, just as another reminder, so in the summary of economic projections, the FOMC is going to be releasing the latest dot plot. The prior one was released at the December summary of economic projections. The markets are looking at this for any changes in the FOMC's long and short-term views on the interest rate.
And, you know, that's not going to give us much information. So they can mark to market for this year, and that doesn't tell us anything about the future.
Big question we've got is whether we come down from 3 on a median dot, Matt Lazzetti, to 2. Only takes a couple of policymakers. Matt, what's your base case going into that dot plot?
So our base case is that they stick with 3 cuts this year, but as you mentioned, it only takes 2 people to move. So I think there is a very real risk that they move to only expecting 2 cuts this year. We expect the dots further out actually to come up, 2025, 2026, and the long run dot to move higher. I think how much impact that has on markets will depend on, you know, how many dots move for 2024. Is it a signal that there's a wholesale rethink about the policy outlook? And then obviously how Chair Powell communicates it in the press conference. My expectation would be that even if they move to 2 cuts, that Chair Powell does want to keep June live and on the table for a rate cut. And if it does, that should moderate any effect on the market.
Matt, has the balance of risks shifted and been more weighted toward the inflation picture rather than the deterioration picture?
Look, I think you've gotten 2 stronger than expected inflation prints. The breakdown of those inflation prints was not good from the Fed's perspective in terms of higher shelter inflation, higher core services ex shelter, the things that they're worried about being stickier. So yeah, I think, you know, just over the past 2 months or so, you have seen a shift. And I think with the SEP, we'll have to look at how much the risks around their inflation outlook have changed. But I think we also have to be cognizant. They are hyper data dependent. If you get 2 more better inflation prints through the June FOMC meeting, you know, I think they'll feel better about that risk management consideration and be able to back off and reduce rates at that point.
Matt, what do you think better is? What would look like better?
I think you need 0.2% core PCE prints over the next 2 months. I think they need to see year-over-year core PCE at 2.5% or lower. That is our baseline expectation, but obviously we also are a little bit more uncertain about that, have a little less confidence in that than we did two months ago.
In the press conference, Matt, what kind of language do you think Chairman Powell is going to reach for? The same kind of words that he used only a few weeks back?
You know, it was somewhat surprising to me that 2 weeks ago he said that they're kind of quote-unquote not far from having that confidence. You know, I would think that he's a little bit further away after getting another worse inflation print. But at the same time, I think that there are enough one-offs at the beginning of the year, seasonal adjustment factors, portfolio management, inflation picking up, that they still should have confidence in the disinflation trend. I expect them to communicate that and to suggest that really they just need to see a few more data points. And if they get that confidence, that they're willing to cut rates.
Matt, just the last question on the balance sheet. We were told this was going to be a big meeting on the balance sheet. How big is it? What kind of decision should we expect, if we should expect any decision at all?
I think it's a big meeting in terms of discussions. I don't think it's a big meeting in terms of decisions or announcements. So they're going to have an in-depth discussion about the balance sheet, mostly focused on what do they need to see to slow down the pace of QT. I think we'll probably
So we're now 10 minutes away from the top of the hour. We do see the release of the FOMC interest rate decision, summary of economic projections, and rate statements as well. So the FOMC at this meeting widely expected to keep rates unchanged at 5.5%. If realized, attention will turn to the rate statement, but more importantly this time around, the summary of economic projections. The markets will be looking for any changes in longer-run inflation and GDP forecasts in this SEP. Again, alongside the much-anticipated dot plot, which will be outlining FOMC voters' forecasts on the short and long-term US interest rates. Quick note from UniCredit ahead of this release, as they expect the FOMC to leave interest rates and the pace of balance sheet reductions unchanged at this meeting. FOMC's updated macro projections are likely to be little changed as well, UniCredit note, indicating 3 rate cuts this year, and UniCredit still expect rate cuts to start in June and a total of 125 basis points of cuts this year.
But also to do it at a pace that is slow enough not to risk financial stability.
Kathy, what are the financial stability risks?
UniCredit also comment that the risks are skewed towards the median dot, moving up slightly, and more so for this year than beyond, given the recent stronger inflation data, as well as the upward skew of the December SEP 2024 dots, when 8 participants expected less than 3 cuts and 5 expected more than 3 cuts.
It becomes important that there's enough liquidity in the system. And they're trying to figure out what that balance is precisely in terms of drawing down QT to keep enough in the system and still continue to reduce the balance sheet. And they're really stuck with those mortgages. I mean, part of the problem, they're just stuck with these mortgages for now, and that's going to be a problem.
Kathy, let me take you back a few months where everybody was wondering about the functioning of the Treasury market in view of massive issuance by the government. Question was who was going to buy, and you have QT on top of all that. What has happened to all that discussion?
Households have stepped up. When we look at who has been buying, it's the usual suspects have continued to buy, but the increase above issuance largely has been households. So when you look at people, they don't even realize they hold. If they have money market funds, they have treasuries. If they hold, short-term treasuries, they hold short-term bond funds. Chances are they hold treasuries. And as those yields hit 5%, had a big jump in households. So I think that 5%, in my view, has been the level that's really pulled in a lot of capital. And when it comes to issuance, I don't sit around. I don't put that high in my list of concerns. There'll be a buyer.
Mohammed, Kathy's talking about all this cash sloshing around. And when we were at Bank of America yesterday, they talked about how savings accounts are 40% higher now than they were pre-pandemic. Where is all of this coming from, especially because the Fed's supposed to be draining the system of liquidity?
So I think the household liquidity is A, how much it benefited from the pandemic, and B, let's not forget, when we see strong employment, strong wages, that generates income, generates all sorts of financial balances. I think what's fascinating, and Kathy, I would love to hear your view on this, is how did we go from 7 cuts to 2 to 3 while stocks reached record high? Had we been here in December, and I would have told you the market will be proven wrong and it will price in 3 cuts by March, I doubt we would have said, and stocks would mark one record high after the other. So how do we explain that?
Yeah, fortunately, I don't do equities, so I don't have to explain what's going on in the equity market.
That's a pun, because the equity markets do bonds.
Yeah, I have my colleague Liz Ann Saunders, I think, is going to be on later, and she can explain that to you. I do think when we were pricing in 7 cuts, it seemed we never changed. We had 3 to 4 this year. I don't really know what people were looking at, except the previous history from the Fed was always when they hit an inflection point, they tended to go pretty quickly. And at that point, the numbers were deteriorating. But now, we've come back. The economy is more resilient than expected. Inflation's a little stickier than expected. So we've righted the ship here, and we had some communications from the Fed that also pushed back on that notion. What they're doing in the equity market, though, I have no idea.
Before you even ask that question, guess who wrote in? Neil Dutta, Renmac. This is what Neil had to say. If they move the 2 dots from 3 and come down to 2 on the median dot, and they're revising up growth and inflation, is it really a big deal? Earnings are up big. He's talked about nominal GDP. Equities are doing well. And this brings up the Mark Cabana question over at Bank of America. And Kathy, I think we have to think about this to some extent. Mark Cabana at Bank of America was telling Lisa and I yesterday that maybe the bond market should be looking to the equity market for clues as to what's happening here. Stocks are rallying on better nominal GDP data than we expected to
In
start the
5
year.
minutes time now, at the top of the hour, see the release of the US interest rate decision. So the forecast is for no change at 5.5%. Also see the release of the FOMC's summary of economic projections and the rate statement, which, if the no change is realized, is where attention will be turning. So Morgan Stanley note that on the net, we think that not much has changed for the Fed. Morgan Stanley expect changes to the SEP to paint a picture of optimism around supply-driven growth, higher GDP forecast coupled with an unchanged forecast for core inflation. Morgan Stanley also think that the median view for rate cuts remains at 3 this year and continue to expect the first rate cut in June, followed by a pause, then cuts in September, November and December. So Morgan Stanley also pricing in a total of 100 basis points of cuts this year per their current forecasts.
But I think if I were at the Fed, I'd want to get more numbers on the
Morgan Stanley do acknowledge, however, there is a risk that the median moves to 2 cuts for this year. After a pop in January, incoming inflation data points to a big reversal in core PCE services inflation, excluding housing, which is a key focus for the Fed. So Morgan Stanley notes that at a higher level, assuming their core PCE forecast is correct,
has often driven inflationary cycles.
they see the Fed's forecast of 2.4% core PCE this year. Monthly pace would need to average 0.17% for the rest of the year in order for the Fed to hit their target.
No, it's a tough job. I'm glad I'm not trying to stand up there in front of everybody and answer those questions about fiscal policy at the press conference today. But it's true, fiscal policy has been very supportive to households, and you have a lot of jobs, and when people have jobs, they spend money. And so the Fed has to adjust their expectations based on that.
Well, we had this in the early 80s when fiscal was on the accelerator and monetary policy was on the brakes. Right. And we saw what happened there. Do you think how much of the 80s rather than the 70s do you think we're going to see?
Oh boy, I remember the 80s. It was great for bond trading. I mean, we had so much volatility every day. It was fantastic. That being said, it doesn't feel like the 80s to me. I don't think we have the same dynamics in the economy that we had in the 80s. You know, you were getting huge increase in labor force participation then. Women coming into the workforce, the baby boomers just sort of hitting their stride. That was a more dynamic economy and a far more volatile commodity situation. We've got a bit of a rise in commodities now, but it's nowhere close to where it was in the 80s. So I don't feel like the dynamic's quite the same.
I'll tell you what this reminds us of, and we've been talking about it over the last month or so. This reminds me of the post-GFC period in reverse. So post-GFC, we're all waiting for liftoff, and every single bank on the street was forecasting liftoff about a year out. 12 months out, the Fed's going to start hiking. They had to wait 5-6 years for it to happen. Mohammed, I'm wondering whether this era is going to be that in reverse, where every 3 months we're looking 6 months out waiting for liftoff hikes that never come, or rather cuts that never come. Is that going to be the GFC period, post-GFC, in reverse?
So let me give you my probability distribution. And you tell me whether you agree or not.
Sure.
55% we soft land. 30% we go into a recession. 15% we never slow down. Whether you call it a no landing or you call it positive productivity shock because of AI.
Just 15.
15. Okay, so 55, 15, and then 30 that we hard land.
Is the 15 the one that's had to be revised higher since the start of the year?
It's the 55 that has been revised higher.
Okay.
Okay. So that's how I think of it. In that context, it is unlikely that we will not cut rates.
1 minute remaining. I'll be leading with the US interest rate decision.
Great to catch up with you alongside Mohammed Al-Arian. Mohammed's going to stick with us going into this decision. Let's check out the scores. If you are just joining us, we're about a minute away from the Fed decision. The scores look like this going into it. Equities very close to all-time highs, pulling back just a touch. Bramo, we're down about 0.1% on the S&P. We're very, very close to all-time highs. This is not where we thought we would be. To Mohammed's point, at the start of the year, we had March penciled in. Many houses did, looking for a rate cut in March and anticipating that if we pulled out those cuts for this year, down from 6 towards the Federal Reserve, who were at 3, then this equity market would sell off. This stock market has not sold off.
And we've been talking about Jensen versus Jay, and that's sort of where we're at right now. The NVIDIA AI craze versus Jay Powell trying to put the brakes on an economy that seems to have more gas left. This is really ultimately the
10
question.
seconds.
It doesn't surprise me that there's very little movement in stocks or bonds right now, because why would anyone try to front run this given the proclivity to maybe a little bit more volatility post-news conference?
Well, let's turn to the bond market and we'll talk about where we've been before today. Yields have been climbing higher over the last week or so. Fixed income, treasuries, 2-year, 10-year,
So seeing
30-year, look like this. We're down about 2 basis points on a 2-year.
Seeing the CBO 30-year debt, Fed rate no change rate remains unchanged at 5.5% as expected. CBO 30-year debt and deficit forecasts are lower due to discretionary spending limits passed by Congress, stronger GDP growth due to increased immigration. The CBO project is debt held by public's fiscal year. Fed officials, median view of the Fed funds rate end of 2025 at 3.9%, previous 3.6%. Risk to employment and inflation goals are moving into better balance. Remain strongly committed to getting inflation back to 2%. Fed projections show 9 of 19 officials see the policy rate above 4.6%, median forecast for 2024. Fed projections imply 75 basis points of rate cuts this year from the current level, additional 75 basis points next year as well. Median view of the Fed funds rates in the longer run, 2.6%, up from the 2.5% previously. Inflation has cooled over the past year but remains elevated, and projections show higher long-term policy rate projections at 2.6% versus 2.5% in December. Projections show one fewer rate cut in 2025 than previously forecast. Fed policymakers see the end of 2024 PCE inflation at 2.4%, unchanged from the December projection. Core seen at 2.6%, which is up from the 2.4% seen previously. Economic outlook is uncertain. Central bank highly attentive to inflation risks. Projections show only one official seeing more than 3 25 basis point rate cuts for this year. Policymakers upgrade the 2024 GDP growth forecast to 2.1% from 1.4%, seeing unemployment rates at 4% versus 4.1% in the December projection. In describing state of the job market, amidst January's characterization of jobs gains having moderated, economic activity expanding at a solid pace, job gains remaining strong, unemployment rates low. The Fed also maintained their current pace of balance sheet drawdown. Following this, upside move in the S&P 500, downside in the dollar as well. So again, U.S. interest rates remaining unchanged at 5.5% as expected. A slight upward revision to the inflation forecast, as well as the longer run interest rate forecast as well in this dot plot. We have posted that out on the feed for anybody interested.
The same median dot with some changes around the surface, I know, in and around, it's more nuanced than that, but ultimately the exact same median dot than December, as December. Mike, can you make sense of that? How have we just revised growth higher, revised unemployment lower, and core inflation up for 24 and left the median dot unchanged?
Well, you have to look at it as the median dot, because others did change their views around that dot, but nobody moved significantly higher to push rates up. One person did. They needed 2 to move it up, to move the median rate up. But as I noted, 9 of the 10 now say 2 cuts or less. So it is certainly possible, if we see similar inflation and jobs numbers going forward, that this could change again. And at the next meeting in June, when they put out a new forecast, they could go to 2.
I guess no wonder people are buying stocks right now. Mike, we'll come back to you in just a moment. On the S&P 500, positive by 1/3%. Here's the price action for you. Stocks higher. On the NASDAQ, up by 0.4%. In the bond market, a rally at the front end. We're down about 4 basis points to 4.64 on a US 2-year yield. And the dollar a little bit weaker here. The euro at 108.85. Brad, my first reaction to this, just to see faster growth for 2024, lower unemployment and higher core inflation, and a median dot. And we can get into the changes beneath the surface, I know, but a median dot that's unchanged in the face of all of that. If you're in equities at the moment, that sounds pretty bullish to me, doesn't it?
This is a Federal Reserve that suddenly, under the hood, seems to be accepting higher than expected inflation for a longer period of time. taking longer to get down to that neutral rate, because there is no other way to interpret all the numbers that you just laid out: hotter inflation than expected for the next couple of years, faster growth, and the fact that they're still planning for similar types of cuts highlights where the bias is right now for a Federal Reserve that still does want to cut rates.
If you're just tuning in, joining us around a table, Mohammed El-Arian is alongside us, together with Priya Misra, fixed income portfolio manager at JP Morgan Asset Management. Priya, I want to cross over to you. Just your first thoughts on the projections and the statement that we got just moments ago.
I think this is a Fed that really wants that soft landing to continue. They saw a path of that for that soft landing. Now, we have had better inflation data, higher inflation data than the Fed would have liked, I think, the last 2 months. But it's 2 months. You know, you just go back 4 months. We had really weak inflation data in November and December. Jan and Feb came in a little higher.
Traders priced in additional Fed easing in 2024.
I think the Fed is saying we're going to be patient. There's a long time between now and December. Those projections are December projections. That growth getting higher, I wonder if they're telling you the supply side's working, whether it's population growth, whether it's supply chains coming back, that's allowing growth to be strong, that's allowing the labor market to be okay. And the Fed is saying, be patient. We're going to get close to that 2%. It might take a little bit longer. We can start normalizing.
Well, it's fueling a rally in gold. Gold is up by 0.6% off the back of some of this. Mohammed, your thoughts on what we've just heard from this Federal Reserve?
So I would have agreed with everything that she said, with one exception, which is a revision up in the PCE core to 2.6. So that puts me more in Lisa's camp. I think this is a signal, and the market is taking it as that they will tolerate slightly higher inflation for longer.
This is a reason why maybe if you look incrementally under the hood, you're seeing some inflation expectations over the longer term start to pick up just a little bit. Priya, from that point of view, does this kind of call, all things being equal, make you less enthusiastic about longer-term treasuries if it seems like this is a Fed that wants to stick the soft landing regardless of what the data might be suggesting and even their own projections?
I would say the belly of the curve is still the most attractive, because, you know, whether they cut 2 times or 3 times, let's look at the total amount of cuts that's priced in. The neutral rate that the market is expecting, or the end point, is 3.75. I mean, the Fed's neutral rate is 2.5. The market is well north of that. So the part of the curve that's the most, I'd say, sensitive to the totality of rate cuts is that 5 to 10 year part. You're right, going out into the 30-year, there's term premium, there's supply demand. But I will say if the soft landing continues, that $6 trillion sitting in money market funds starts to go into bond funds, equity funds, that's a positive for duration as well.
Mohammed, I have to say, this idea of potentially inflation being higher for longer, when is it kind of a sort of tacit acceptance of 2 point something you've talked a lot about, rather than looking for 2% as even a goal? If it takes 10 years,
commentary from Nick Timiraos, the Fed whisperer on the Wall Street Journal on Twitter, says fewer FOMC officials see upside risks to their unemployment forecast compared with December, but more of them see upside risks to their inflation forecasts.
Soft landing, we have to redefine what we think is the inflation rate that goes with that soft landing. It is not 2, I think it's near to
US
3,
yields falling after the Fed's 2024 median forecast held steady.
I wish that these forecasts came out before the semi-annual testimony, because I do wonder how different the questions would have been. There would be serious questions now about how serious they are about getting inflation back down to target. Lisa, I think we have to go through these numbers. If you're just joining us, here they are. So I'll give you the number now, the forecast for 24, and you can compare it to December. As Mike McKee explained quite clearly, these are the median projections. 2.1% for GDP for 24. In December, it was 1.4. The unemployment rate for 24, 4%. In December, it was 4.1. PCE, 2.4, December 2.4, core PCE 2.6, December 2.4. The median dot for this year unchanged at 4.6, implying 3 cuts. Now, Bramo, if you put that in front of any committee, any press conference, the obvious question for any journalist today, this afternoon, is how serious you are taking it to get it back to 2%. Because based on that, I mean, what are you taking seriously? And I think you absolutely nailed it. Are they beginning to tolerate something a bit above target?
Because ultimately they want to prioritize the labor market over inflation data that is noisy, and they've talked about that in higher than expected. I will just say, if it came out before semi-annual testimony, I wonder if they'll ask about Bitcoin, because they probably wouldn't read it and then ask that question. But I'm glad that we have good journalists who are going to be asking that question in the press conference.
I think Senator Warren also sent another letter recently saying you should cut rates like right now?
Maybe they're listening.
Yeah, I'm sure that won't come up in the news conference a little bit later. Joining us to discuss this one is Dan Swank, the chief economist at KPMG, alongside Bank of America's Michael Gapin. Dan, I'd love your reaction just to these projections and what you've heard so far from this Federal Reserve.
Well, I think a couple of things are really important. First of all, the threshold to cut rates is a little higher than many people thought, but also they're not talking about raising rates, even though they've had this higher inflation. And I do think, remember, they're going through their process of reevaluating where rates are, what is the optimal inflation rate and what is the optimal policy path. And I think on hedging, what they're doing right now is they're saying we're willing to hold it higher for longer to get there. And, you know, Jay Powell really made this point that markets sort of ran off on in December, is that we don't think we need a recession anymore to get back to our inflation target. They're willing to be patient to get down there. I do think over time there is going to be a debate of what is the optimal inflation rate. Is it 2.5%? I don't think it's closer to 3%, but I do think that there is something to the fact that they're willing to tolerate a little higher inflation for a little bit longer rather than higher unemployment. But they also are not willing to, raise rates again, and I think that's important too. But the threshold to cut is a little higher than it was prior to this meeting.
Dan, before I get Mike Gapin's thoughts, I just want to come back to you on something you said. We don't need a recession is very different to we don't want one. Do you think that is the difference this afternoon? Is this we don't need a recession to get inflation back to target, or we don't want one? Diane?
Oh, I think it's that they don't need a recession. They don't believe they need a recession, and they don't want one if they don't need it. So I think that's really the important two pieces to this equation, is that if they had to take a recession, August 2022, bucket of cold ice on us at Jackson Hole, we'll take a recession if we need it to get inflation down. They were wrong. We didn't need it. They got pretty far. We've made enough progress now that to take a recession to make it the last mile on this road on inflation, it's not worth it. And I think that's the hedge that you're seeing played out right now.
Mike, there also is a bit of a shifting in the goalposts, given the fact that we're looking at inflation that's coming down, but not coming down to 2%, and then that's okay. That is considered success. How much is this statement and these projections really signaling an acceptance of higher inflation for longer to you?
So to me, it's not. I mean, I think they're looking at changing policy today or setting policy today and trying to get to their macro objectives over the 3-year forecast horizon. They're still saying we'll get there in 2026, which is the same story that they've given in the past. So yes, they have to tolerate a little higher inflation in the near term this year and next year. But I don't think they're giving up on that 2% goal. I think the flavor to the revisions, to me, says the median member is fully embracing this supply side story, and the economy can run faster, at least temporarily, without generating significant overheating pressures. So to me, that's the main message from the statement, although I acknowledge with revising up the inflation path 0.2 this year, 0.1 next year, does say we may have to have a little higher inflation in the meantime, but I don't think they're giving up on that 2% target.
Priya, I see you vigorously nodding. You agree?
I completely agree. I think it's the supply side. That's the key. I think the entire soft landing was predicated on the Fed starting to ease. What they're telling us is that the starting point matters. We're at 5.5 on Fed funds, 10-year real rates at 2%. This is restrictive policy. Can they start to normalize, start to cut a little bit? Not the entire cycle. They don't have to cut consecutively all the way down to 2.5%. Start that process of normalization. If that means inflation's a little higher than their target this year, so be it. We'll get there in the next couple of years. If the supply side is working, it allows growth to be strong without creating inflation. Maybe the target is 2 to 3%. I don't think they can politically say it or have much credibility. It's like me saying I can't run a marathon when I can't run 100 meters. But essentially, when you can't reach your target, you should not change the target. But can they act as if you'll get there? We just push out that 2% a year out or 2 years out. I think that's what they're telling us. They're telling us, let's start. We're not committing. This is a data-dependent Fed. We can decide 25 and 26 cuts. We have a lot of time to do that. Let's just start the process now because we're in restrictive territory.
Priya, is that a reason to buy the 10-year Treasury or sell it?
The 10 years harder. It's a reason to buy the 5-year. For now, I would say buy it because I think this keeps demand coming into fixed income. I think the rates market was actually slightly hawkishly positioned into this meeting because of this debate between 2 and 3 cuts. The equity risk assets have been on a tear. I mean, there's been nothing stopping that. I don't think now anything stops it because unless the growth data weakens, the Fed's telling you they're willing to let this run. They're willing to ease to allow that soft landing to continue.
Dan, I'd love your thoughts on how to navigate this news conference when there is such a clear and obvious contradiction in the median projections for 2024. How do you think Chairman Powell will explore this one in 16 minutes' time?
He's going to be straight in and full on we're still committed to getting to 2%. He will not back off that kind of rhetoric, and I think that's important. He's saying we're just willing to, we've not changed the time frame. It's just going to come down a little slower than we thought. But also there's a trade-off. You know, are we willing to create unnecessary pain, which is the Fed's word for euphemism for unemployment, for no reason? Do we really need that at this point in time? And I think what they're saying is no. We see, even in the labor market, we've seen a surge in immigration. We've seen a rebalancing in the labor market that's continuing. If the labor market were to get significantly softer, they would cut more rapidly. I think that's the other side of this that is interesting, is that are starting to see sort of a division within the Fed on what are the balance of risks. But at the end of the day, the Fed is looking at this saying, we've had a pretty resilient economy.
Amazon is developing a new AI tool for online shopping, according to The Insider.
How fast we get there doesn't matter given the progress we've made. And I think, you know, it does matter if it's 10 years, like Mohammed said, yes, then it's not. But I think in the context of where we've been and what we're doing, this is sort of the way to think about it as a way to not cause undue pain in the economy for no reason.
So then I agree with you, and I think it's important that we're redefining patience. Going into this meeting, patience meant there's no rush to cut rates. Now patience means we may have to wait a little bit longer to get to 2%, or the path will be slightly different. But whenever I say that out, the reaction, the pushback I get is, but that's going to destabilize inflation expectations. I don't think it will.
So
do you agree? Do you agree that it will not?
Yeah, I'm with you, Mohammed, on this. I don't think it will, because we've seen remarkably anchored inflation expectations throughout all this. Now, if it did begin to, the Fed would be changing its tune pretty quickly, right? So this is something they're looking at. They're looking at that inflation expectations have been fairly well anchored, and that's a good sign for them that this is an okay path to take. But you're absolutely right. If we were to see inflation expectations shift on the basis of this, they'd have to change their tune and their strategy.
Mike Gapin, I want to give you the final word going into this news conference. What would you look for?
Well, I think that the balance, so what's been discussed here is essentially, you know, do you really have a higher bar to start? Are you less confident about starting? We all seem to think that they still have a lot of confidence about disinflation remaining in place. So I would kind of address those two confidences. And honestly, I would try and tease out any information on the balance
So regarding the market
the
reaction to this FOMC decision and the SEP, we saw US equities jump to session highs this afternoon as the Federal Reserve held interest rates steady and signaled that the central bankers are expecting 75 basis points of cuts this year.
No doubt about it. Mike Gapin of Bank of America.
So the Fed's so-called dot plot was in focus, as investors had speculated that a recent uptick in economic activity and inflation could lead to fewer cuts this year. So in the end, the Fed signaled the same number of rate cuts the market had already priced in. So it does seem that this lack of deviation from the prior expectation is what caused the strength in US indexes, weakness in the dollar and government bond yields as well.
You're all making me feel a little bit uncomfortable because you all agree with each other, so I've got to be that guy, and I think Lisa's on the same page as me. There's going to be a lot of people watching this that just think, well, hang on a minute. There's a huge contradiction in all of this, that you've revised higher inflation, revised lower unemployment, you're looking for a faster economy, and your projection for rates stays unchanged. That sounds super dovish, and I would say displays a real tolerance for above target inflation, with equities at all-time highs and credit spreads very, very tight. Why are we wrong when people come on this program and say we are sufficiently restrictive? In fact, some people come on this program and say significantly so. Where is the evidence of that based on what we're seeing this afternoon? Where is the evidence, Mohammed?
So the evidence was given to you earlier by Kathy, which is if you just look at one price, which is where the policy rate is, relative to where core PCE is, that's where you get the restrictive. But I agree with you. If you look at the financial conditions as a whole, these are very loose financial conditions.
One thing that I'm looking at in the statement is that the Fed took out language saying job gains had moderated. It really was the only change to the statement. Priya, from your perspective, everyone's been saying it's all about the labor market. If we don't see moderation in the labor market, and if it's actually reigniting, how are we going to get down to 2%? From here, if maybe people are saying it's restrictive, the equity markets and the credit markets didn't get the message.
So I think the labor market is coming in better balance. It is moderating. It may not be moderating in terms of NFP numbers every month. It's moderating in terms of the quits rate. It's moderating in terms of job vacancies or average hourly earnings, ECI. You look at measures of wage inflation, it is moderating. I think that's what gives the Fed comfort that those inflation expectations will be anchored, that even if core PCE is a little bit higher
At 2:30 p.m. Eastern Time, we get the FOMC press conference with Chair Powell.
Of PCE that might be keeping it a little bit higher for longer. But as long as the labor market suggests that wages are moderating, I think it gives the Fed that confidence. And I would say for them to start to cut, I think cuts in 2024 are about inflation. PCE has gone from 5.5% to 3%. That's a reason for them to cut 75 basis points. Cuts next year are about growth in the labor market.
To me, Mohammed, this all goes back to your point, which is this a Federal Reserve that is operating without an overarching kind of thesis? They're basically just trying to cobble together people's different opinions and putting something out there, and then it sends us all in a tailspin trying to explain some sort of cohesive theory behind it and where we're going. Is that what this smells like? We're trying to sort of rationalize and come up with a theory behind this when it's really this person thinks this person thinks this is a good kind of happy medium. Go figure out what to do with this.
So if you want to be generous, you'd say this is such an uncertain economy. There's so many things changing on the structural side that they have no choice but to behave like they're behaving. If you want to be less generous, you'll say this is a Fed that actually took a view. It looked through data in 2021 and ended up really undermining its credibility. And therefore, it is very hesitant to do anything more.
According to Echoes, the French government deficit estimated around 5.6% in 2023.
Minutes away, we'll find out if Robert Tipp is feeling generous of PGIM. He joins us now. Robert,
And US Treasury yields now higher after the Fed 10-year yields last at 4.297%.
Yeah, I mean, I think that in terms of supporting what they've done, the rate of growth of the economy has been firm. The rate of inflation has come down at a headline basis by 5-6%, by nearly 3% on a core basis. The question came up earlier, do they want a recession? I think they want a soft landing. And they got conditions restrictive enough to bring down inflation quite a bit. Wage growth has decelerated, and they managed to do that, while unemployment has remained low. Growth has continued. So I think it's been a very successful go. Did they start late? They did start late. But I think their pandemic practice, was a little bit late. I don't think we have a lot of active central banker data points in terms of how you're supposed to do it. So I think so far, so good. And I think they're trying to hone the message so far here.
You sound very positive on all of this. Does that mean that you're a buyer of bonds of all durations because you think that ultimately they will get to the goal that they're looking for, along with the soft landing that's always been called sort of the unicorn that never arrives?
Well, I think the unicorn arrived in 2019. After the 2018 cycle, we were on our way to a soft landing. That was interrupted by pandemic, so maybe not. The late 90s, another soft landing after the 94 cycle. So I think they are there. I think the problem is a lot of people saw the dot-com bubble burst. They saw the GFC burst. And we don't have that kind of a backdrop now. And a lot of people are used to seeing funds rate up, funds rate down, crash, big problems. They're not used to seeing it. It doesn't mean it never happened. So it has happened, and looks like we're on our way there. Is this a buy point for fixed income? It is. Strategically, when you get to the end of the Fed rate hiking cycle, That's where you're going to be seeing the peak in interest rates. That was probably at the end of September last year. We're getting into that buy zone at the end of 2022. We remain there now. We're seeing a lot of support for the market. I think that's why the risk premiums in the market are so narrow, but they're likely to remain narrow. But I think overall, they're managing a very successful course here.
So, Robert, clearly a soft landing is your baseline. So speak a little bit to your level of confidence in that. And what do the tails look like if the Fed were to end up making a mistake? And we hope the Fed doesn't make a mistake. But if it were, what do you think the most likely mistake would be?
Right. Well, I think the data has not only bifurcated, it's trifurcated. Right. So when you look at the employment, I was a little surprised that they went, unidimensional, that it's, a super employment market. I mean, the household survey has been flat for a few months. Unemployment rate has inched higher. Jobless claims at a state level have gone higher, triggering some people to wonder about whether the Somme rule is kicking in, signaling a potential recession. And of course, recessions are very hard to spot. So I think if there was going to be a problem here, you're not going to wake up one day and see data consistent with a 3.5% growth.
At 2:30 p.m. Eastern Time, we get the FOMC press conference with Chair Jerome Powell. We have put the live stream out on the feed for all those interested.
And you've lost a little bit of momentum. I think that's the more likely side that things could break on. Having said that, they're at 5.3%. They have tightened in real terms. They've made the case they didn't really want to do that. Now they're making the case they want more information. I think if they see slower data, that would, trigger them to make some cuts, which would end up, probably preempting a recession. So the most likely mistake would be kind of a growth recession. I would think that would be the next most likely scenario there.
Priya, is there a downside to keeping inflation hotter for longer, in the idea that this is actually really problematic for particularly lower income households? As Mohammed and I were talking about before the show, that this is sort of, very much attacks on particularly people with lower income, specifically for those who are not in the market and can't capitalize on some of the gains that we see in the equity markets and could have a drag on the economy.
Sure. I think as long as the job market is fine and wages are running above inflation. So you talk about that inflation number being high. Where are wages? If wages are running 4% and inflation's at 2.5%, there's still positive real income growth. So I think as long as you have positive real income growth, that danger that you talk about is less of an issue. I do worry about the danger from, is the Fed easy for too long, or does it let the market run on this narrative of rate cuts? If inflation stays high enough, at some point, the Fed's idea of continuous rate cuts is going to get questioned. And I think that no market is pricing that in. I think risk assets are expecting rate cuts this year, rate cuts next year. So if that inflation tends to be that last mile problem actually exists and we find we're unable to get close to 2%, I think then we should reprice all those long end rates higher, which is a problem for, you keep talking about credit spreads. Is that a problem for spreads or overall risk assets? I think that's the danger I worry about. I don't think we're there yet. It's still, it's noisy data, but I think that is something we should watch as we see the totality. And I hope Chair Powell's asked about that. Is it 3-month moving average? Is it core, super core, shelter?
Yeah.
I mean, we have so many variables. We look at revisions, wages. So hopefully he's asked exactly, and I'm sure he's going to give a non-answer answer, which is everything. But maybe some nuggets in there. It's core and super core that we look at. I think just a sense of what gives them that confidence that overall we're going to get to 2%.
Frances Don of Manulife was on the programme earlier on this morning. She said exactly the same thing. Just tell us what you're looking at. Seems to change from meeting to meeting. Robert, I know you've got to go. It's got to catch up, sir. Robert Tibb of PGIM going into this news conference 3 minutes away. Mohammed, what do you want to hear from the chairman in this news conference? What do you want to hear him address?
What I'd like him is to come across as steady, to not get the market excited, to not cause undue volatility.
That's what you want. What do you expect?
It's hard. I would not like to be at
not generous view.
I would not like to be at that podium after this outcome. I really would not like to be there.
Why is that? You think the members have put him in a little bit of a sticky spot?
Yeah.
To explain this?
I mean, you've repeated over and over again that the data revisions and the projection, the revision to the language, the revision to projections are inconsistent with the non-change to the rate cuts.
How difficult is this going to be, Priya, in 2 minutes?
I think he's pretty good at doing that. I think he might at least try and get that delicate balance. I mean, he is going to be asked about financial conditions. They've eased a lot. I think explaining that's context dependent. Financial conditions by itself, the Fed should not have a view on. It's relative to the economy. We're in a soft landing. Financial conditions should be easier. Now, all he can do is explain the reaction function. We didn't get any data today. Explain the reaction function. They remain data dependent. I'm also looking for anything on QT.
Shortly expecting the beginning of the FOMC press conference.
Might get to zero in the next 2 months. What are they doing then? Are they getting close to tapering? If they're going to debate this and we get a September 19 event, that's a big shock to the system. I don't think is priced in.
John, everyone's been talking about the fact that we haven't heard about the balance sheet. It wasn't in the statement. And to me, this is actually a wild card because it's this sort of tacit tightening. They're going to allow it to run off for longer than people previously expected because this is one tool that they can do without getting into the rate cutting dance.
Does that help him today, considering that he doesn't think it's passive tightening and this is just watching paint dry? Does that help him?
Well, based on what Priya was just saying, it sounds like this might be watching paint dry as well, because she was basically like, he's not going to give an answer. And Mohammed's like, please don't shake anything up.
There's a reason that we're waiting for these comments, though, on the balance sheet. It's because at the last meeting, he sat there in the news conference and told us that it would be a big meeting for a conversation about the balance sheet. So maybe you hear about that up front when these comments begin.
Maybe that's one way to kill the mood in the room, just to talk about the balance sheet roll-off and just go into exact detail about what this means. There are a lot of questions. I want to hear financial conditions first and foremost. Exactly how he responds to that. Does he brush it off in the same kind of way that he did back in December?
It's not a major deal, but it's the beginning of something that could be a big deal. There's just a clear and obvious contradiction in the outlook for 2024. I think if you see a repeat of that through the year, there's going to be more and more questions about how willing and how they are really focused on, whether they are really focused on getting that inflation number back towards 2%.
It kind of goes back to Priya's analogy, which is your target can be to run a marathon. But if you don't really run it all, and you just run a mile a day, and you don't plan to do it until 2046, is that really your goal anymore? And I think that that's sort of one key question here as we talk about what is an inflation target that we're looking at that's 2%.
It's a complicated spot for the chairman. We've got equities at all-time highs as he's about to open that door and sit in front of that lectern.
NYMEX diesel April futures settle at $2.69 a gallon. NYMEX gasoline April futures settle at $2.73 a gallon.
Still forecasting the same amount of cuts for 2024. I think that's a sticky spot for any Fed
NYMEX WTI crude April futures settle at $81.68 a barrel. That's down $1.79 or 2.14%. And seeing NYMEX natural gas April futures settle at $1.69.
Here's the chairman of the Federal Reserve.
And Fed's Powell says the economy has made considerable progress. Inflation has eased substantially.
Our dual mandate to promote maximum employment and stable prices.
Fed's Powell says ongoing progress is not assured, though, and the path forward is uncertain.
Toward our dual mandate objectives. Inflation has eased substantially, while the labor market has remained strong. Good news. But inflation is still too high. Ongoing progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation. As labor market
Fed's Powell says risks to achieving the Fed's goals are moving into better balance.
Achieving our employment and inflation goals are moving into better balance. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace.
Powell says GDP has been bolstered by strong consumer demand as well as healing supply chains.
For 2023 as a whole, GDP expanded 3.1%, bolstered by strong consumer demand as well as improving supply conditions.
Powell says high interest rates have weighed on business, fixed income investment.
Over the past year, largely reflecting high mortgage rates. High interest rates also appear to have weighed on business fixed investment. In our summary of economic projections, committee participants generally expect GDP growth to slow from last year's pace, with a median projection of 2.1% this year and 2% over the next 2 years.
Fed's Powell says supply and demand is coming into better balance.
Since December, reflecting the strength of incoming data, including data on labor supply. The labor market remains relatively tight, but supply and demand conditions continue to come into better balance.
So according to Nikkei, the Bank of Japan is seen weighing the next rate hike in July or October as the yen weakens.
The unemployment rate
And
has
Powell says
edged
nominal
up but
wage
remains
growth
low
has
at
been
3.9%.
easing.
Strong job creation has been accompanied by an increase in the supply of workers, reflecting increases in
Powell says labor
participation
demand still
among
exceeds
individuals
labor
aged
supply.
25 to 54 years, and a continued strong pace of
And Powell
immigration.
says the GDP forecasts were
Nominal
revised
wage
higher
growth has been
because of
easing,
data on
and
labor
job
supply.
vacancies have declined. Although the jobs to workers gap has
FOMC
narrowed,
participants
labor
expect
demand still
rebalancing
exceeds
in
the
labor
supply of
market to
available
continue.
workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressure on inflation. The median unemployment rate projection in the SEP is 4.0% at the end of this year and 4.1% at the end of next year. Inflation has eased notably over the past year, but remains above our longer-run goal of 2%. Estimates based on the Consumer Price Index and other data indicate
Powell
that
says inflation
total
expectations
PCE
remain well
prices
anchored.
rose 2.5% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as from measures from financial markets. The median projection in the SEP for total PCE inflation falls to 2.4% this year, 2.2% next year, and 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation.
The S&P 500 erased earlier gains, heading toward flat on the session, still up 0.09%.
Today's meeting to maintain the target range for the federal funds rate at 5.25%
Fed's
to
Powell says
5.5%,
our policy rate is likely at its peak, and risks to goals are coming into better balance.
Holdings. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation
Powell says we are
goals
likely to
are
cut
coming
rates
into
at some
better
point
balance.
this year.
We believe that our policy rate is likely at its peak for this tightening cycle, and that
But the outlook is
economy evolves
uncertain, and we
broadly as
remain
expected,
attentive to the
it
risks.
will likely be appropriate to begin dialing back policy restraint at some point this year.
Powell says we
The
are
economic
prepared to
outlook
keep
is
rates
uncertain,
higher
however,
for longer
and
if
we
needed.
remain highly attentive to inflation risks. We are prepared to maintain the current target range for the federal funds rate for longer, if appropriate. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving
Fed's Powell
outlook,
says we
and the
need
balance
greater
of risks.
confidence inflation is moving
The committee
sustainably
does not
down
expect
before
it
we
will be
cut
appropriate
rates.
to reduce the target range until it has gained greater confidence that inflation is moving sustainably down toward 2%. Of course, we're committed to both sides of our dual mandate.
Powell says
and an
unexpected weakness in
weakening
labor
in the
market
labor
could warrant a
could
response
also
too.
warrant a policy response. We will continue to make our decisions meeting by meeting. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 4.6% at the end of this year, 3.9% at the end of 2025, and 3.1% at the end of 2026, still above the median longer-term funds rate. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability
FedSpal
goals.
says on the balance sheet, we discussed
Turning to our
issues
balance
related
sheet,
to
our
slowing
securities
pace
holdings
of
have
declines in
declined
the
by nearly
holdings.
$1.5 trillion since the committee
Our
began
general
reducing
sense
our
is we will
portfolio.
start runoff fairly
At this
soon.
meeting, we discussed issues related to slowing the pace of decline in our securities holdings. While we did not make any decisions today on this, the general sense of the committee is that it will be appropriate to slow the pace of runoff fairly soon, consistent with the plans
Powell
we
says
previously
slowing the pace
issued.
of runoff will ensure a
The
smooth
decision to
transition.
slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach that ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our securities holdings, consistent with reaching the appropriate level of ample reserves. We remain committed to bringing inflation back down to our 2% goal and to keeping our longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and price stability over the long term. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you.
Steve Leisman, CNBC. Mr. Chairman, the projections show somewhat higher core inflation. They also show somewhat stronger growth. What should we infer from this notion that on average rates were kept the same this year, but inflation is higher and growth is higher? Does it mean more tolerance for higher inflation and less of a willingness to slow the economy to achieve that target?
Well,
Powell says the projections do not mean higher tolerance for inflation,
we've seen incoming,
and notes that
as I
inflation
pointed out in my
data did
opening
come in a
remarks,
little bit
we
higher
did
than
mark up our
expected.
growth forecast, and so have many other forecasters. So the economy is performing well. And the inflation data came in a little bit higher as a separate matter, and I think that caused people to write up their inflation. But nonetheless, we continue to make good progress on bringing inflation down. And so...
When you just to follow up, when you say that you're willing to either maintain the rate for longer, what is the
Noting the dollar yen falling after the Nikkei headline, still up 0.14%.
So we're strongly committed
And Brent crude futures settle at $85.95 a barrel. That's down $1.43 or 1.64%.
We should believe that because that's what will happen over time. But we stress over time, and so. I think we're making projections that do show that happening, and we're committed to that outcome, and we will bring it about.
Rachel. Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. You and others have been saying that relief on housing inflation is coming, but it still hasn't shown up meaningfully.
FedSpal says there's some confidence that lower market rent increases in housing will show up over time.
Breakthrough, since it hasn't at that point.
I'm just not sure when that will be.
There's some confidence that the market rents, lower market rent increases that we're seeing will show up in measures of housing services inflation over time. There's a little bit of uncertainty about when that will happen, but there's real confidence that they will show up eventually over time. But again, uncertainty about the exact timing of that.
Okay. And will you be able to get overall inflation down to target if housing doesn't break through quickly, and does that affect the timing for eventual cuts this year?
And FedSpal says, I assume we will continue to see goods prices continue into equilibrium.
And I would assume that what we'll continue to see is we'll see goods prices coming into a new equilibrium where they're
So the Dixie weakens further, down 0.25% at 103.57.
Inflation will come back down as current market rents are suggesting will happen. And where non-housing
and U.S. Senator McConnell says the Senate may be in this weekend for the spending bill.
From the combination we had before the pandemic will be achieved and will bring inflation back down to 2% sustainably.
Nick
Tim Ross of the Wall Street Journal. Chair Powell, during your congressional testimony this month, you said that your test for making the first change to interest rates does not require you to be terribly comfortable that inflation is at 2% because interest rates are well above neutral. At the same time, you said here after the last meeting that the first cut is highly consequential. Can you reconcile these views for me? If rates are well above neutral, why would the first cut be highly consequential? Is that because
Powell says the risks are really two-sided now.
By one or two more along the lines of the recalibration you made in 2019, which itself was modeled on the mid-cycle adjustment of 1995?
It's more, I would put it more in the context of what I said in my opening remarks, that the risks are really two-sided here. We're in a situation where, you know, if we ease too much,
Powell says the first rate cut is therefore consequential.
And if we ease too late, we could do unnecessary harm to employment and you know, people's working lives. And so, you know, we do see the risks as two-sided. So it is consequential. We want to be careful. And fortunately, with the economy growing, with the labor market strong, and with inflation coming down, we can approach that question carefully and let the data speak on that. That's really what I was thinking.
How much of that inflation that we've seen so far this year do you chalk up to one-off calendar adjustment effects following a period of high inflation versus some change in the trend we saw in the second half of last year?
So I want to start by saying
Powell says January CPI and PCE numbers were quite high, but could have been due to seasonal adjustments.
But I would say the January number, which was very high.
And Powell says February was also high, but not terribly.
There's reason to think that there could be seasonal effects there. But nonetheless, we don't want to be completely dismissive of it. The February number was higher than expectations, but we have it at currently well below 30 basis points core PCE, which is not terribly high.
Powell says it will be a bumpy path.
January number. But I take the two of them together, and I think they haven't really changed the overall story.
And Powell says, I don't think they added to anyone's confidence.
Gradually on a sometimes bumpy road toward 2%. I don't think that story has changed. I also don't think that those readings added to anyone's confidence that we're moving closer to that point. But you know, we didn't. Last thing I'll say is we didn't excessively celebrate the good inflation readings we got in the last 7 months of last year. We didn't.
Powell says we are not going to overreact to these 2 months of data, nor ignore them.
That we could, you know, we wanted to be careful about that decision, and we're not going to overreact as well to these 2 months of data, nor are we going to ignore them.
Hi, yes, Chair Powell. Could you speak a little bit more about the timing? Is there enough data between now and, say, May to be able to get the kind of confidence that you say that, you know, you still need, or by June, is there enough data for you? Just give us a sense of your thinking there. Thank you.
Yeah, so we make decisions meeting by meeting, and we didn't make any decisions about future meetings today. Those are going to depend on our ongoing assessment of the incoming data, the evolving outlook, and the balance of risk. So I really don't have anything for you on any specific meeting looking forward.
But I mean, just a question of, I mean, is there even enough data for you to be able to?
We'll take, you know. Things can happen.
Powell says we want to see more data that gives us higher confidence on inflation moving down sustainably.
I wouldn't want to dismiss anything. So I just would say that the committee wants to see more data that gives us higher confidence that inflation is moving down sustainably.
Noting spot gold rising 1%.
And we don't see this in the data.
Powell says if there were a significant weakening in the labor market, that would be a reason to start rate cuts.
That could also be a reason for us to begin the process of reducing rates. Again, there's nothing in the data pointing at that, but those are the things that we'll be looking at coming meetings, and without trying to refer to any specific meeting.
Chris.
Hi, Chris Regaber, Associated Press. Thank you. In the projections, there is an increase in the neutral rate, as you know, and higher rates, a quarter point higher rates projected in 2025, 2026. Can you speak about what might be behind that? Is there a real sense here that the economy has perhaps changed in some way, that higher rates will be needed in the future? Thank you.
So You're right. They're pretty modest changes, but you're right. There was an uptick in the longer run rate, and
Fed's Powell
and
says,
also
I
there's
don't
a
think we
25
know
basis
that
point
rates will be
increase in
higher if
25 and 26. In terms of are rates going to be higher in the longer run?
So Powell says, I don't think we know if rates are going to be higher in the longer run.
I think we think that rates were generally
Lower
low
inflation or
during
weaker
the
jobs data
pre-pandemic,
could drive
post-global
rate
financial
cuts.
crisis era for reasons that are
And Powell
mostly,
says, my instinct is rates won't go back down to very low levels we saw before.
large things like demographics and productivity and that sort of thing, things that don't move quickly. But I don't think we know. I mean, my instinct would be that
Powell notes
rates would not
that
go
there is
back down
tremendous
to the very low
uncertainty
levels
around
we
that.
saw, where all around the world there were long-run rates that were at or below zero in some cases. I don't see rates going back down to that level, but I think there's tremendous uncertainty around that.
Great. And just a quick follow on the projections, you also have 2.6% core inflation for the end of this year. It's already at, or you mentioned it being 2.8 in February. I mean, that doesn't sound like much disinflation at all. So are you still confident, or last press conference you sounded pretty optimistic you would get more confidence to the end of this year. Is it right
Vitol
to say that this
CEO
suggests you're not
Hardy
seeing a lot
says
of
the company has moved
disinflation
back
this year
forecasts for
compared to
peak
what we've
oil
seen
demand to early
2023?
2030s
I think that
because
that higher
transition is
year-end,
taking longer than expected.
number reflects the data we've seen so far this year, because you're now in this year. So I think that. Sorry, say your last part of your question again.
Well, just, are you still optimistic that you'll get the confidence you need this year?
I think if you look at
Powell says it is still likely, in most people's
um,
view, that we will have
still
rate cuts
likely
this year, but it depends on
most
data.
people's, view that we will achieve that confidence and that there will be rate cuts. But that's really going to depend on the incoming data. It is. The other thing is, in the second half of the year, you have some pretty low readings, so it might be harder to make progress as you move that 12-month window forward. Nonetheless, we're looking for data that confirm the kind of low readings that we had last year and give us a higher degree of confidence that what we saw was really inflation moving sustainably down to 2%, toward 2%.
Gina Smilik, The New York Times. Thank you for taking our questions. Per your comment to Ann that a weakening in the labor market would be a reason to potentially cut rates, or at least a consideration in making a rate cut, would continued strength in the labor market be a reason to hold off on rate cuts? And
Powell
just
says,
in
I'm looking for
general, if
data
labor supply
confirming low
continued to
inflation
rebound in
data last year.
2024, the way it did in 2023, what would stronger hiring and possibly stronger growth mean for the path forward on policy?
Yeah, so if what we're getting is a lot of supply and a lot of demand, and that supply is actually feeding demand because workers are getting paid and they're
Fed's Powell on the labor market says if we are getting a lot of supply and demand, you could potentially have a bigger economy where inflation pressures are not increasing.
Where inflationary pressures are not increasing. In fact, they were decreasing. So you can have that if you have the continued supply side activity that we had last year with both with supply
Fed's Powell
chains and
says
also
strong hiring
with,
by itself
growth
would
in the size
not
of
be a
labor force.
reason to hold off on a rate
But
cut.
so strong hiring in and of itself would not be a reason to hold off on rate cuts?
No, not all by itself, no. I mean, we saw, you saw last year, very strong hiring and inflation coming down quickly. We now have a better sense that a big part of that was supply side healing, particularly with growth in the labor force. So in and of itself, strong job growth is not a reason, for us to be concerned about inflation.
Neil. Hi, Chair Powell. Neil Irwin with Axios. How do you assess the state of financial conditions right now, and in particular, do you view the kind of easing in financial conditions since the fall as consistent?
Fed's Powell
and
says
compatible with what
ultimately
you're
we
trying to
do
achieve
think
on
financial
inflation
conditions
mandate?
are weighing on
So
economic
I think
activity.
There are many different financial conditions indicators, and you can kind of, see different answers to that question. But
US stocks
ultimately,
extend
we do
gains,
think
NASDAQ
that,
up
financial
1.01%.
conditions are weighing on economic activity, and we think you see that in a great place to see it is in the labor market, where you've seen demand cooling off a little bit from the extremely high levels. And there I would point to job openings, quits, surveys, the hiring rate, things like that are really demand. There are also supply side things happening, but I think those are demand side things happening. You know, we saw, that's been a question for a while. We did see progress on inflation last year, significant progress, despite, you know, financial conditions sometimes being tighter, sometimes looser.
Michael McGee with Bloomberg Radio and Television. Can you give us more color on how the committee is thinking about inflation dynamics now? What we've seen at the beginning of the year, are they more one-off increases that will fade, or is there more of a secular turn with goods prices rising again and service prices staying sticky? And also, housing prices have been sort of the Godot of this cycle, in that you keep expecting them to go down and they don't. How does the committee see this playing out forward since you've raised your inflation forecast?
So I see the committees looking at the 2 months of data and asking the same question you're asking and saying we're just going to have to see what the data show. As I mentioned, you can look at January, which is very high reading, and you can, and I think many people did.
Fed's powell says we tend to see a little bit stronger inflation in the first half of the year.
But again, you don't want to, you got to be careful about dismissing the parts of the data that you don't like. So then February wasn't as high, but it was higher. So the question is, what are we going to see? You know, we tend to see a little bit stronger.
Fed's powell says we don't know if this is a bump on inflation roads or something more.
Strong later in the year. We're going to let the data show. I don't think we really know whether this is a bump on the road or something more. We'll have to find out. In the meantime, the economy is strong, the labor market is strong, inflation has come way down, and that gives us the ability to approach this question carefully and you know, feel more confident.
Fed's powell says many saw possible seasonal problems in January's inflation print.
Take that step to begin dialing back our restrictive policy.
Well, you've talked about the desire to have confidence that inflation is continually moving down. Has the recent numbers we've gotten for inflation data dented that confidence at all?
It certainly hasn't improved our confidence. It hasn't raised anyone's confidence, but I would say that the story is really essentially the same, and that is of inflation coming down gradually toward 2% on a sometimes bumpy path, as I mentioned. I think that's what you still see. We've got 9 months of 2.5% inflation now. And we've had 2 months of kind of bumpy inflation. We were saying that it's going to be a
Powell says we need to take time to assess if recent inflation represents more than bumps in the road.
And we can't know that. That's why we are approaching this question carefully. It is very important for everyone that we serve that we do get inflation sustainably down. And I think the historical record, you know, every situation is different, but the historical record is that you need to approach that question carefully and try to get it right the first time and not have to come back and raise rates again, perhaps, if you cut inappropriately, prematurely.
Thank you, Mr. Chairman. Edward Lawrence with Fox Business. I wanted to ask you, you received a letter from, the Federal Reserve, first independent body, understanding Congress has oversight over that. You received a letter from Senators Elizabeth Warren and Sheldon Whitehouse that said, calling on you to lower interest rates, to cut interest rates, because it says, quote, the potential that it may remain too high for too long has halted advances in deploying renewable energy technologies and delayed significant climate and economic benefits from these projects. So has higher interest rates caused that?
Have they? Well, first of all, I respect in our system of government, it is Congress that has oversight responsibility over the Fed. We place a tremendous amount of importance on our engagements with Congress and always treat them with great respect. In this case, I would say those are, our mandate. Our mandate is for maximum employment and price stability, and the other things that we do, and that's what we're trying to accomplish. We're trying to do that in a way that sustains the strong growth we're seeing, the strong labor market we're seeing, but allows us to make further progress with inflation. That's how we can best serve the public and leave the other issues, which in many cases are incredibly important, such as those you mentioned, leave those to the people who have responsibility for those.
There was another letter from 24 lawmakers saying that the higher rates are squeezing the working people. How do these letters affect what you guys are doing policy-wise?
We receive these letters with respect, and we write careful responses and address concerns. We listen, again, because we're talking to the people who in our system of government have oversight over our activity. So but at the end of the day, we take that on board, but we have to make our judgments, and we have to stick to our knitting, which is maximum employment, price stability, supervise and regulate the banks, work on the payment system, the things that we do.
Thank you. Claire Jones, Financial Times. Thanks a lot for the opportunity to ask a question. As chair of the FOMC, would you want to see unanimity on the committee or something close to it, meaning no more than one dissent before you begin cutting rates? Thank you.
We're a very consensus-oriented organization, and we do try to achieve consensus and ideally unanimity. People do dissent. It's something that happens. Life goes on, and it's not a problem. We've always had dissents, and so you respect thoughtful dissents very much. It's like you may not agree with some arguments, but you really want to understand them. So you may read a book that takes a position that you have long opposed, just to understand that book. So I treat dissents with real respect as well.
So Simon, one would be okay.
Simon Rabinovich with The Economist. Can you hear me?
Yes.
Okay, great. Obviously, inflation is some ways away from target. Unemployment, though, if you look at the projection for the full year, 4.0%. In February, we were already at 3.9%, so quite close to the median projection. Are you concerned at all that, notwithstanding the very strong jobs growth,
Fed's power says I don't see cracks in the labour market, and Treasury 2-year yield falls 9 basis points to the day's lows of 4.59%.
What would constitute that in your books? Thank you.
So we, of course, monitor it's one of our two goal variables.
And Powell says we are seeing a strong labour market and extreme imbalances are mostly resolved.
Today. And we follow all the possible stories that are out there about there being cracks. But
Powell notes that wage growth is gradually moderating.
The extreme imbalances that we saw in the early parts of the pandemic recovery have mostly been resolved. You're seeing high job growth. You're seeing big increases in supply. You're seeing strong wage growth, but wage growth is gradually moderating down to more sustainable
Powell says
levels.
things are returning more to pre-pandemic state.
Things are returning more to their state in 2019, which we can think of as normal for this purpose. That's job openings and quits, and surveys of workers and businesses are always interesting on this. How tight is how easy is it to find a job? How easy it is to find a worker? Those surveys have both come down. So the labor market's in good shape.
Powell says we are closely watching layoffs.
The low hiring rate, and people have made the argument
and initial claims are very low.
If layoffs were to increase, then that would mean that the net would be fairly quick increases in unemployment. So that's something we're watching, but we're not seeing it. Of course, initial claims are very, very low, and if anything, have tracked down a little bit. So watching it carefully, don't see it. And when I say something, I use the term unexpected weakening in the labor market. So, we do expect the unemployment rate to, the forecast is that it would move up, I think, closer to what we see as the longer run sustainable level. That's just people's forecast, individual forecasts. But we're talking about something that's unexpected. That's where I'll leave it, though.
Steve Matthews with Bloomberg. You mentioned at the beginning of the press conference that the committee felt it might be appropriate to slow the pace of asset runoff fairly soon. I'm wondering, when you say fairly soon, does that mean that the committee would meet about this again in May, and a decision could be reached that soon. And
Powell says we do expect the unemployment rate to move up.
The scope of what the committee is discussing here. You're at $95 billion of caps right now. Would that be cut about in half or something in that nature? Thank you.
So that is what we're discussing. Essentially, and we're not discussing all the many other balance sheet issues. We will discuss those in due course. But what we're really looking at is slowing the pace of runoff. There isn't much runoff among MBS right now, but there is in Treasuries, and we're talking about going
Fed's
to a lower
Powell
pace.
says in terms of timings in regards to the balance sheet runoff, no more specific than fairly soon.
That's what we're looking at. And in terms of the timing, I said
Powell
fairly
notes
soon.
liquidity is not evenly distributed.
But you get the idea. The idea is, and this is in our longer run plans, that we may actually be able to get to a lower level because we would avoid the kind of frictions that can happen. Liquidity is not evenly distributed in the system, and there can be times when, in the aggregate, reserves are ample or even abundant, but not in every part.
Fed's Powell says we might be able to get to a lower level of reserves over time.
Cause you to prematurely stop the process to avoid the stress, and then it would be very hard to restart, we think. So as something like that happened in 19, perhaps. So that's what we're doing. We're looking at what would be a good time and what would be a good structure. And, fairly soon is words that we use to mean fairly soon.
And will there be a discussion about returning to an all-treasury?
Powell says our longer run goal is to return to balance sheet that is mostly treasuries.
Our longer run goal is
Powell notes it's not urgent to decide that right now.
That is mostly treasuries. I do expect that once we're through this, we'll come back to the other issues about the composition and the maturity, and revisit those issues. But it's not urgent right now. We want to get this decision made first, and then we can, when the time is right, come back to the other issues.
Hi, Victoria Guida with Politico. Also on the balance sheet, can you talk a little bit about how the outlook for the banking sector might impact your balance sheet plans? Do you worry that as deposits start to shrink that we could see more turbulence?
We'll be watching carefully, but one of the reasons we're slowing down, we will soon enough, fairly soon, I should say, slow down, is that we want to avoid
Powell says one reason to slow asset runoff is to avoid turbulence.
I wasn't thinking particularly about banking sector turbulence, but we had some indicators the last time. This is our second time in doing this, and I think we're going to be paying a lot of attention to the things that started to happen and that foreshadowed what eventually happened at the end of that tightening cycle, where we wound up in a short reserves situation, and we don't want to do that again. And I think now we have a better sense of what are the indicators. It wasn't so much in the banking system as it was around, for example, where federal funds is trading relative to the administered rates, and where secured rates are relative to the administered rates. Those sorts of things. We will always be watching the banking system for similar signs, though.
Well, is it also because you're not sure exactly how the reserve supply will react once the overnight reverse repo facility, drops near at zero?
I think we broadly think that once the
Fed's Powell says we broadly think that once the overnight repo stabilizes as balance sheet shrinks, reserves should decline pretty much dollar for dollar.
Pretty close to dollar for dollar with that. That's what we think.
Hi, Chair Powell. Jean Young with M&I Market News. I wanted to ask also about the balance sheet. You said that starting the taper sooner could get you to a smaller balance sheet size. Does that mean you don't have to make a decision on when to end QT at this point?
Powell says by going slower on the balance sheet, we think we can get further.
For deciding that sooner, or will you wait until we're close to the end?
So
it will mean we run much less risk of liquidity issues.
You can get farther, but that's the idea. The idea is that with a smoother transition, you'll run much less risk of kind of liquidity problems which can grow into shocks and which can cause you to stop the process
Fed's
prematurely.
houses will be monitoring money market
that's where, in terms
conditions
of how it
carefully to
ends,
know when to stop
we're
on
gonna be
balance sheet runoff.
monitoring carefully money market conditions and asking ourselves whether what they're telling us about reserves, are they, right now we would characterize them as abundant, and what we're aiming for is ample, and which is a little bit less than abundant, right? So there isn't there's not a dollar amount or a percent of GDP or anything like that where we think we have a really pretty clear understanding of that. We're going to be looking at what these what's happening in money markets, in particular, a bunch of different
Fed's
indicators.
pal says right now we would characterize reserves as abundant.
Then, though, you reach a point, ultimately, where you stop allowing the balance sheet to run off, but then, from that point, there's another period in which non-reserve liabilities grow organically, like currency, and that also shrinks the reserves at a very slow pace. So you have a slower pace of runoff, which we'll have fairly soon. Then you have another time where you effectively hold the balance sheet constant and allow non-reserve liabilities to expand, and then that ultimately brings you ideally in for, brings it into a nice easy landing at a level that is above what we think the lowest possible ample number would be. We're not trying for that. We want to have a cushion, a buffer, because we know that demand for reserves can be very volatile, and we don't want to again find ourselves in a situation where there aren't reserves. We have to turn around and buy assets and put reserves back in the banking system the way we did in 2019-20.
Hi, Nancy Marshall-Genzer with Marketplace.
Fed's pal says we are looking at incoming inflation data most importantly.
Inflation is getting to your 2% goal before you cut rates. Can you just sum up more specifically what data you're looking at that would give you that confidence?
Sure. So most importantly, we're looking at the incoming inflation data and the contents of it and what they're telling us. So that'll be, and also the various components. So obviously that's what we want. We want more confidence that inflation is coming down sustainably toward 2%. And I mean, of course, we'll also be looking at all the other things that are happening in the economy. We'll look at the totality of the data, including everything essentially, as we make that assessment. But the most important thing will be the inflation data that's coming in.
Well, are there things that you would give more weight to, like wages?
Wages is one thing. We don't. Our target is not wages. It's really inflation. We would look to the fact that wages are still coming in very strong. But
Fed's pal says wage increases are gradually coming down to levels more sustainable over time.
Quite strong, but they're gradually coming down to levels that are more sustainable over time, and that's what we want. We don't think that the inflation was not originally caused, I don't think, mostly by wages. That wasn't really the story.
Powell says, I don't think inflation was mostly caused by wages.
We'd like to see, continuing gradual movement of wage increases at still high levels, but back down to levels that are more sustainable over time.
Let's go to Greg.
Thank you. Greg Robb from MarketWatch. Chair Powell, could you say at this meeting whether there were more officials who wanted to be careful and go slower about rates than were at the last meeting? Was there that sense of maybe it's smart to wait? Thanks.
I guess I'd put it this way. If you look at the incoming inflation data that we've had,
Fed's pal says incoming inflation data for January and February very broadly suggests we were right to wait until we're more confident.
Suggests that we were right to wait until we're more confident. So I think I didn't hear anyone dismissing it as not information that we should look at or anything like that. So I think generally speaking, it does go in the direction of saying yes, it's appropriate for us to be careful as we approach this question.
Thanks
Thanks, Chair Powell. Brendan Peterson with Punchbowl News. I wanted to ask you about central bank digital currency stuff. We've been hearing a lot from Republicans in Congress about what the Fed is or isn't doing in a digital dollar. But folks, I know you have said to Congress that you are going to wait for approval before the Fed does anything, launches anything. But folks like House Majority Whip Tom Emmer have said that the Fed is either actively researching or hiring personnel to study the implications of a CBDC. Can you give us any clarity on what the Fed is doing right now on a digital dollar?
Sure. So I think we've been pretty transparent on this, but I'll try harder. So we are not getting ready to, we haven't proposed, we haven't come to a conclusion that we should propose or anything like that, that Congress consider legislation to authorize a digital dollar. And it would take legislation by Congress signed by the president to give us the ability to do what we think of as a CBDC, which is really a retail CBDC with the public of it. So we're just a long, long way from that. What we are doing, and I think what every major central bank is doing, is we're trying to stay in the frontiers of what's going on in digital finance. And it has many, many different areas. You know, it has applications in wholesale finance, in the payment system, and so we to serve the public. These issues have become very front burner in the last 5 or 6 years. We need to be knowledgeable about all that. So we actually do have people trying to understand things that are, but it's wrong to say that we're working on a CBDC and then we've secretly got a lab here where we've got one and we're just going to spring it on Congress at the right moment. We don't. I haven't at all in my own mind made a decision that I think this is something the U.S. should be doing. I just think it's something we need to understand, and we do have people who are keeping up with that as part of the broader payments landscape. That's how I would characterize it.
Thank you. It's Mark Hamrick with Bankrate. Mr. Chairman, April 27th will mark the 13th anniversary since a Fed chairman began holding regular news conferences. How important has that higher transparency been in your view, both for the proper functioning of the central bank and also in accomplishing your mission? And is there more that you and your colleagues can do on the transparency front, and what might that look like?
I generally think, this movement actually started, 30 years ago, when some academics posited that a more transparent central bank, if the public understands your reaction function, the markets will do your work for you. They'll react to the data. And so it all happens that way. And so there's been a march toward greater and greater transparency. And that certainly Chairman Bernanke advanced that, so Chairman Greenspan did, Chair Yellen did. And so we went from four press conferences a year to 8, so now every meeting really is live now. I think that's a good innovation. I wouldn't want to turn it back. We also have done a bunch of other things. We have an annual supervision report, financial stability report. There's a long list of things that we've done. I think nothing comes to mind as really desperately in need of doing at this moment. We're very transparent. We have no shortage of FOMC participants speaking to the public through the media. And so that channel is full, I would say. So I think it's generally broadly helped and made things better, but not every day and in every way.
Well, to follow up, has there ever been a day where you wanted to put that genie back in the bottle somewhat?
Of course not.
Let's go to Jennifer for the last question.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. Not to harp too much more on confidence and inflation, but you did say earlier in this press conference that the recent inflation data hasn't raised anyone's confidence. But when you testified before the Senate a couple weeks ago, you told lawmakers that you are, quote, not far from receiving the confidence needed on inflation to begin cutting rates. So are you still of that belief or not? What are we to take by those words, not far?
So let me say my main message at that in those 2 days of hearings was really that the committee needs to see more evidence to build our confidence that inflation is moving down sustainably toward our 2% goal, and we don't expect that it will be appropriate to begin to reduce rates until we're more confident that that is the case. I said that any number of times, so those were kind of the main part of the message. We repeated that today in our statement. I also, to the language you mentioned, I really pointed out that we had made significant progress over the past year, and what we're looking for now is confirmation that that progress will continue. We had a series of inflation readings over the second half of last year that were really much lower. We didn't overreact, as I mentioned, but that's what I had in mind.
But given that you said that PCE for February, 2.8%, the estimate, and that we have been seeing PCE, core PCE, coming down by 10% every month, I mean, wouldn't you be at about 2.4% this summer, June, July, to a point where you could cut then?
Well, we'll just have to see how the data.
So Powell has ended the press conference.
We would, of course, love to get great inflation data. We got really good inflation data on the second part of last year. Again, we didn't overreact to it. We said we needed to see more, and we said it would be bumpy. And now we have January and February, which I've talked about a couple of times. So, we're looking for more good data, and we would certainly welcome it.
Thank you.
Thank you.
If you're long stocks, you didn't want this to end. Live from New York City this afternoon, good afternoon. This is special coverage of the Federal Reserve meeting. Let's start with the scores. All-time highs on the S&P 500, positive by 0.8%.
Vitol CEO sees limited gas demand growth in Europe and more consumption will come from Asia.
On a 2-year, yields lower by 6 basis points to 461.93. So let's talk about the why. The why is in the outlook, the projections from the Federal Reserve. Growth revised higher, unemployment revised down, inflation revised up, all maintaining the same median dot, implying 3 cuts in 2024. So there was a clear and obvious contradiction in the outlook and a clear and obvious question to ask in this press conference.
US stocks extend gains, Dow Jones up 1%.
It doesn't mean that. What it means is that we've seen incoming, as I pointed out in my opening remarks, we did mark up our growth forecast, and so have many other forecasters. So the economy is performing well. And the inflation data came in a little bit higher as a separate matter, and I think that caused people to write up their inflation. But nonetheless, we continue to make good progress on bringing inflation down.
There's 2 ways to interpret this, the unkind way and the kind way. The unkind way, if you're a Fed basher, you would say he wasn't prepared for that question. The kind way would be to assume that he was. And there was a message, a signal in that non-answer. Bramo, I have to say, I'm in the latter camp and not the former.
I would agree. I actually think that there was a message in this because honestly, he didn't really push back on financial conditions either and didn't really have any concrete answer. I heard a lot of words. I didn't hear some sort of answer to our financial conditions moving the economy in the wrong direction, which makes me think he's comfortable with it. He's not going to push back. This is a Fed that wants to cut rates. They still want to cut rates. And when he talked about inflation coming down over time, I'll stress the over time.
Yep.
This is higher inflation for a longer period of time that will be tolerated by this Federal Reserve.
Strong growth isn't a problem. Equity markets at all-time highs, not a problem. The Fed chair, and I think this is important, how they've set up the perceived asymmetric policy stance of the Federal Reserve in the minds of so many in this market right now. The Fed chair is signaling repeatedly he is more willing to respond to weaker growth than he is stronger growth. So even if you project stronger growth, Bramo, it doesn't matter. He doesn't mean he's going to raise interest rates anytime off the back of that, but weaker growth, they're ready to go.
And you pointed this out. He distinguished the idea of growth that was hotter from inflation as though those stories were independent of one another. And it raises this question, are they still looking at this as a supply-side driven kind of issue that caused the inflation, kind of the pandemic effects and the ripple-throughs that will naturally subside? Which raises the question, have they really done anything to inflation, or is this just some sort of other type of influence that they're kind of riding and trying to game out?
You know what stood out to me as well? The story hasn't changed. When he says the story hasn't changed, yet the data has, I think the meaning of what he's saying has changed. The meaning is different. If you say the story hasn't changed, even though inflation comes in hotter than expected, you're sending a very different signal to the one that you were sending even a month, 2 months ago.
And you can see that just frankly in the data that they should put out there. The forecasts exactly are not the same. When they talk about core PCE coming to 2.6% at the end of this year versus the expected 2.4% previously, when you talk about the growth projection increasing materially, this is a shifted kind of landscape with higher inflation and a higher rate for longer. But they're saying the story hasn't changed, which again talks about a green light to stocks, which is exactly what we're seeing.
Let's bring in the guests with equities at all-time highs. We can catch up with Bill Dudley, the former New York Fed president and Bloomberg Economics senior advisor. Bill, the Fed chair said we're committed to getting inflation back to 2%. How committed did he sound in that news conference?
I don't think he's changed the story at all. I think what people are a little bit flummoxed by is the fact that the Fed sees stronger growth, a little bit higher inflation, yet the same number of interest rate cuts penciled in for 2024. I think the reality is it almost flipped. I mean, one more person had moved their interest rate forecast up, it would have been 2 rate cuts as the median rather than 3, and people probably would be interpreting this in a much more different manner. I think, Powell's confident about a couple things. Number one, that inflation's coming down. Number two, that that the labor supply is increasing, and that's creating slack in the labor market. And 3, that monetary policy is tight, and that's why he's confident that eventually he's going to cut rates. It's just a question of timing.
Bill, do you think that there's something incompatible about shifting upward a growth target, shifting upward a targeted PCE for the end of the year, and even shifting up just slightly where rates are going to be and saying the story hasn't changed, that the inflation target is still the same, it just might take a lot longer?
I think what people, misinterpret is the summary of economic projections is not a Federal Reserve forecast. It's not Powell's forecast. It's a collection of individual forecasts. And the Fed doesn't coordinate the S&P. They're not trying to, go out and ask people to write down certain numbers to tell a certain story. It's just a collection of individual forecasts. And as we see in this case, one dot moves, you have a slightly different story. So I think that Powell's basic message is that the underlying story hasn't changed. We didn't completely buy into how good the inflation numbers were for the second half of next year. We're not completely put off by the bad inflation readings in January, February. We still think monetary policy is tight. We still think we're going to get more confident about getting inflation down to 2%. And so we still think we're going to cut rates this year. Timing is uncertain. And he said over and over again, it depends on the data.
Bill, not all dots are created equally. Where do you think Chairman Powell is on this story right now? Because it just seems to me there is a bias to cut interest rates. Steve Risciuto of Mizuho came on this program in the last week or so, and he said this Federal Reserve wants to cut interest rates. Chairman Powell wants to cut interest rates. Is the bias to cut, regardless of what the data looks like?
I wouldn't go as far as to say the bias is cut no matter what the data looks like. I mean, the Fed's still committed to trying to get inflation down to 2%. But I think what's driving Powell is the fact that he thinks that monetary policy is restrictive. So if you stay at the current setting, the economy will gradually slow, and that will set the stage for less strength in the labor market, which will then motivate cutting interest rates. That's what he's highly confident about. When he got the question today about financial conditions, he showed no concern at all about financial easing and making the economy too strong. I thought that was noteworthy because in the past, he's talked about financial conditions a lot as an important way that monetary policy gets transmitted to the real economy. But this time, he did not take the bait on financial conditions easing. And of course, when he doesn't take the bait on financial conditions easing, what does it do? It causes financial conditions to ease more.
It's a green light to buy stocks. That's exactly what's happening. The S&P 500 at all-time highs and up another 0.8%. Bill, we often hear that we're restrictive. And there are some people that come on the program and push back against that exactly because stocks are at all-time highs, credit spreads are very tight, and unemployment is still below 4%. What do you point to if you were back on the FOMC just to demonstrate more clearly to people as to why this FOMC believes we are sufficiently restrictive?
Well, first of all, the economy does seem like it's slowing. I mean, we grew 4% in the third quarter, 3-something in the fourth quarter. It looks like we're going to get something like 2% in the first quarter. And there are signs of weakness. I mean, if you look at industrial production over the last year, it's actually been down. If you look at hours worked, they've been soft. So I think the Fed is getting enough evidence that the economy is slowing that gives them confidence that monetary policy is actually restrictive. And of course, as loans mature, they get repriced at higher interest rates. And so, as time passes, you stay at the current level of interest rates, that's going to exert more restraint because it's going to drive up financing costs for a lot of smaller businesses and for consumers.
I guess I want to just sit on the whole idea then of financial conditions and the idea that he didn't push back and that's why it's a green light to buy stocks. Is that correct in your view, that this isn't something that's going to move against them in terms of allowing capital markets to really foster a lot faster growth and potentially even more inflation, like we hear from lenders themselves, even to middle market companies, day after day?
I don't think it's a green light to buy stocks because it could be the wrong decision. Maybe financial conditions are making the economy too strong. Maybe that will keep inflation too high. And in that case, then the Federal Reserve won't cut rates, and then financial conditions will tighten. I mean, one reason why financial conditions are as easy as they are is because the market is highly confident that the Fed's going to cut rates, not just in 2024, but also in 2025. You look at the SOFR futures market; they have rates coming down to about 3.5% over the next couple of years. So it's that prospect of rate cuts that's really providing support to the stock market and to credit spreads. The market basically sees the Fed as having their back. If the economy weakens, the Fed will cut rates. I mean, that's the other thing that came through in his remarks today. If the labor market were to weaken, the Federal Reserve would take that into account in terms of the timing of interest rate cuts. So we don't really have to worry about the economy collapsing, because if it starts to weaken significantly, the Federal Reserve will ride to the rescue with rate cuts.
I'm looking right now at Fed funds futures, and it points to yesterday a 57% chance of a June rate cut. And right now it's something around 69% chance. So increasing the expectation for a rate cut in June, despite the fact that the data didn't give Jay Powell any extra confidence. Some people would look at this and say, okay, maybe they see signs of restrictiveness, although what he pointed to was the quits rate, which is the common sort of thing that people point to as signs of weakness. Other people would say, why the urgency? Is this politically motivated to get going before the election takes off, because then they could potentially be influenced even more there? Is there something else weighing on the decision-making process that's pushing the Fed to err on the side of being a bit more dovish and allowing this economy to run hot?
Well, I think as he said, as inflation comes down, then the Fed can focus on both sides of their dual mandate, not just the inflation side, but also the growth side. And so I think the Fed more and more is conscious of the fact that they want to do enough to bring inflation down to 2%, but they don't want to overdo it and inadvertently cause a recession. So in some ways, the Fed is trying to have their cake and eat it too, right? They want to ease, but not so soon that they run the risk of easing prematurely.
Just to go through these forecasts, it's a big upward revision to GDP. December projection was 1.4%. New projection is 2.1. Core PCE, it goes up from 2.4 to 2.6. And I just want to get into the details of that with you, Bill. Constant Hunter just wrote in, said, why is the equity market up so much with a basically unchanged dot plot? Because productivity is expected to continue, which will allow stronger growth with little additional inflationary pressure. This scenario is good for risk. Can you talk to us about that, Bill? The relationship between stronger growth and maybe muted inflation that doesn't climb that much off the back of a hot economy. How important is that missing ingredient that has been missing over the previous 10 years, say, that productivity that maybe we're starting to see come back through in a stronger way?
I mean, productivity could be part of it. We don't really know what the productivity trend has been. It was very weak during the pandemic, and it's been very strong over the last year. I think the big thing where the Fed's taking some comfort from is the fact that the labor force growth has picked up dramatically, both because of participation rates among working age population has increased quite a bit, and also immigration. So, the real question is, how long is that strong labor force growth going to last? If it lasts all the way through 2024, that allows the economy to grow, more quickly without it generating a tighter labor market. So the growth rate of the labor force is going to be a very, very important factor determining exactly when the Fed can cut rates and at what growth rate.
And Bill, he did mention immigration, and I really, that was notable to me because we heard from Morgan Stanley's Ellen Zentner, and we also heard from Jan Hatzius at Goldman Sachs in his reports where he's talking about immigration as one of the big wild cards for why you have seen some of the wage pressure come off and participation go up, and even some of the unemployment data tick a little bit higher just because some of the new migrants to this country are filing for claims. How much is that changing the dynamic in ways that is unappreciated?
Well, I think, what's happened is we had a very sharp restraint on labor supply during the pandemic. because we weren't letting anybody into this country except people who were coming over illegally. And then all of a sudden you have a catch up for all those people that wanted to come into the country, in 2020 and 2021, 2022, now coming in 2023. So the real question is that just a temporary period of catch up, or do we have a sustained growth of faster labor force growth? So I think that's a wild card for the outlook, frankly.
Hey, Bill, enjoyed this. Fantastic to catch up with you, sir. Bill Dudley there, the former New York Fed president, reacting to that news conference with Chairman Powell. This afternoon, all-time highs on the S&P 500, up 0.9%, up more than 1 full percentage point on the NASDAQ right now. The small caps outperforming, positive by 2.2% on the Russell 2000. In that news conference, Mike McKee asking a couple of questions. He's back out of that news conference for us now. Mike, your reaction to that one, please.
Well, basically, I think Bill Dudley has it right. The chairman was trying to tell people that the situation hasn't changed, even if the Fed is being more realistic, shall we say, about growth and inflation. Now, the thing he left out is that a significant number of members of the committee did raise their inflation forecasts, and that has some implications down the road in that with only one dot needing to switch, we aren't guaranteed 3 this year. We could see, if we get another bad inflation report, this easily flip to 2 dots instead of 3 dots. But for right now, he's saying there isn't really a change.
Bill Dudley pointed to the fact that there was no pushback to the financial conditions point. And this was notable because this is the second press conference in a row that people asked about financial conditions easing, and he didn't take the bait. How much signal is there in this that essentially he is not bothered by the fact that we're seeing stocks at all-time highs?
Well, the Fed doesn't really worry about stocks hitting all-time highs except for if there's some sort of bubble that bursts that they have to deal with. They view it as just another way that people are collecting income. Now, it could be a bubble, but they're looking at the cost of doing business. And right now, what we're seeing is the prime rate is unchanged. Mortgage rates have come down, but only a little bit. Credit card rates have actually gone up on average. Companies are still borrowing, and credit spreads have come down, but they're not borrowing as much as they were. So at this point, is it restrictive? Is it not restrictive? Financial conditions reflect what's happening in the stock market and to a lesser extent the bond market, but not necessarily what's happening in the real economy.
Do you get the sense, Mike, that there's a bit of herding cats here? I mean, as Bill was talking about, Bill Dudley, former New York Fed president, that there is a sense it's not a collective view of what's going to happen. It's each Fed member coming out with their projections and him having to cobble together a narrative about that. Is that essentially what we saw, in particular with the first answer to this question of trying to pull together all of these new pieces?
Yeah, I think the first question was one that any one of us would have asked because it was so obvious. The Fed is raising its inflation forecast, its growth forecast, and not changing the fact that it wants to cut 3 times. Make sense of that. I'm not sure he completely made sense of it, except for the fact, as Bill Dudley pointed out, that not everybody switched their vote. We needed one more dot to move, and we could have seen that. But they do have a problem with the dot plot in that Wall Street tends to see it as a collective forecast rather than as a collection of 19 individual forecasts. And if you break that down, you do see what I was talking about earlier, that a significant number raised their inflation forecast. And so it probably wouldn't take much to tip us into 2 if we continue to see this kind of inflation data. It was interesting, though, that he gave us the Fed's core PCE reading, basically 30 basis points for the month of February. We haven't got that yet, but that would suggest that inflation on a PCE basis is not accelerating the same way we saw CPI and PPI did.
Hey, Mike McKee, thank you, sir. Appreciate it. Trying to explain what's going on in that news conference. Let's just put it this way. The optics, not great when you look at the medians and the shift we've seen now relative to December.
I do like this explanation that basically it's not this sort of cabal coming up with some thesis that he can then put out there. It's him trying to pull together the different narratives. It is an interesting point that they basically leaked the core PCE. They leaked this sort of key metric as reason to not be more hawkish and push back against the market.
So Peter Chair had this to say: the median didn't change for 24, but the average changed by 11 basis points. And at 4.81%, it's closer to 2 cuts than it is to 3. That's a kind of way of shaping things up if you wanted to frame things at the Federal Reserve. In fact, that might have been a better response for the Fed chairman in the news conference to explain what's going on.
Yeah, on the margins, this does shift people to have slightly less confidence, which is the reason why we're looking to potentially cut rates fewer times. We'll have more time to sift through everything and understand whether we actually are making progress. And then everybody would have said, okay, we've heard absolutely nothing.
The fact of the matter is, he didn't go with that option, though, did he? Went with a different option, excused it away, focused on other things. And the fact of the matter is, Lisa, we go back to something we've talked about a million times on this program. Will the Fed have the ability to respond to adverse shocks? The answer is yes, based on the communication we've had. Do they see strong growth as a problem per se? The answer is no, based on the communication we've had. So what do? Today, this afternoon, you buy stocks and you buy the front end of the curve because in the minds of capital economics this afternoon, based on their note, still on track for a rate cut in June.
Which is really the market's view, too. You're seeing that probability increase. Constance Hunter's point is well taken, that what they're looking at is the hope of productivity and the hope of supply-side demand for the labor market to offset some of the growth that would have come with inflation in sort of disinflationary nirvana. We'll see if we get it.
Let's continue this conversation. Jeff Rosenberg of BlackRock is joining us now. Jeff, I just want to know what you've been doing the last hour. Were you running around the trading floor at BlackRock screaming, buy stocks? How did you respond to this one?
No, I think the main reaction is what you've been talking about in terms of the 2 cuts versus the 3 cuts. I mean, I think that's the headline for the bond market and why you're seeing such a big steepening. And as you point out, it was really much closer to a 2-cut scenario, but they didn't go with that at all, and neither did the market narrative. And most of what you got from Chair Powell was kind of dismissive in terms of the uptick in the inflation forecast for 2024. He didn't even mention it in the opening statement. When he got the question on it, it was just a mark-to-market issue. So really trying to kind of hand-wave around the dissonance between stronger growth, higher inflation, and no changes to cuts. But I think that issue is going to be in front of us as we watch the data, play out. They gave the forecast for the inflation. They don't see any changes. But he also said we don't really know. And so I think that'll be a little bit of a longer-term issue. But why you're having such a big reaction on the equity side is because the bond market is quite happy with it. And that interchange about the Fed put is back, will cut rates if there's any weakness in the employment picture, and risky assets love that story.
But isn't that valid? I mean, at a point where we're talking about the potential to answer some of these questions about why there's been this shift on the margins, could this mean inflation is going to stay around for a bit longer? Maybe it's okay because we want to make sure we stick the soft landing. I mean, those would have been clear answers. Isn't the sort of non-answer signal, as John and I have been talking about, to basically look to that Fed put as a likelihood?
Well, it is, but there's a real problem with that. And the risk is that the Fed has just got the read on their degree of restrictiveness fundamentally wrong. Look at the answer to the question that he gave on, how do you know that you're restrictive? It's all looking at the labor market. How do you know that financial conditions don't matter and you can not look at them? He pointed to the labor market. Well, most of the repair in the labor market has nothing to do with the Fed's policy. It's all supply side. And so when you look at the implications of the Fed's policy and financial conditions, and Mike McKee, you talked about this a little bit, I just want to amplify that it does affect the real economy because the transmission mechanism from financial conditions is through confidence, and confidence translates into demand. And so it's absolutely acting in opposite to what the Fed is intending here. And that's a tension that the Fed is ignoring right now, but they ignore it at their own peril. The market is following the Fed narrative, so everybody's happy with it, but the risk is that they're off, and so that inflation doesn't fall as far as everyone's expecting to, and you end up having to do the opposite of what we got today, which is, actually things are stronger, we can't cut as much as everybody expects, and you get the opposite reaction. That's a risk for the future time, but that's why some of this matters.
So, Jeff, this is refreshing, let's put it that way. Once you've identified an inconsistency like that as a market participant, how do you position accordingly? What do you do? What are you doing differently?
So the thing that it highlights is just the asymmetry in terms of market performance. Now, you're not going to see it realized until it shows up in the data, but it highlights that the Fed's actions and its narrative kind of conspire to push people into the same types of trades. And so when you get the surprise on the other side that that might be brewing here. I'm not saying that it is, but it creates a much larger opposite reaction. I don't think you can position for that today because you got to position with the momentum, which is, hey, they're gonna cut 3 times. They're pretty sanguine, and as you've seen in the equity market today, it's everybody back in the pool.
It seems as though there aren't that many people worried about inflation getting unmoored. Everyone seems to say that doesn't seem to be the risk that we're currently facing. The Fed doesn't seem particularly worried about inflation expectations really getting out of their control. All things being equal, does that give you enough confidence to buy longer-term treasuries, 10-year treasuries, 30-year treasuries, with the conviction that the Fed will truly get inflation back down to 2%?
So just a clarification, we're not talking about inflation going back up. We're talking about the failure of inflation to go down to 2% as fast as the Fed expects it to, and therefore they can cut interest rates as fast as they need to because they are more worried about being too restrictive. So it's more about not getting as much as what the market expects than some kind of big change in terms of the inflation trajectory. On the second part of your question, Lisa, super interesting development here, kind of more minor in terms of the headline here, but that change to the longer run dot. And what you saw in the curve reaction is an attempt to try to steepen the curve. Most of the reaction is just in the front end, but you look at the back end and it was flirting with higher rates, positive yield movements to the back end. And it is this longer run story that perhaps the landing point isn't as low as what we think it is today, isn't as low as what it was pre-COVID, that the neutral rate ends up being much higher, and that the path of aggregate cuts is much lower. And then you add on top of that a lot of the fiscal considerations in terms of the amount of debt that's being pushed into the private side and the QT that he talked about, the balance sheet slowing, less support for absorbing that. That challenges the back end of the curve. So I think it's still a much more challenging environment for longer dated maturity interest rates coming out of this meeting.
You put this all together, Jeff. Do you feel as though this Federal Reserve is tacitly acknowledging that they will tolerate a higher inflation rate for a longer period of time if it's going down, even if very gradually, to that 2% level?
Yeah, you know, I think he got that question explicitly, and he said it explicitly. As explicit as the Fed is going to be within the ambiguity of language, he said over time, he stressed over time, and I think the interpretation of that is they're not going to be so worried about hitting 2% immediately. Now, there's a lot of gap and room for interpretation about what is the difference in calendar dates and time between immediate and over time. But I think it's pretty clear that the Fed is not going to press on economic growth and recession for the benefit of going from 3 to 2%. And I think that's pretty clear where this Fed is leaning.
Hey, Jeff, this was awesome. Really thoughtful stuff. Thank you, sir. Jeff Rosenberg there over at BlackRock. You want 2 moves in this equity market right now. Stocks, all-time highs. Take another guess at what hit a record high just moments ago. A fresh all-time high. Gold. Not just stocks, but gold as well, Bramo, breaking out and getting back up there.
So there's one way to interpret this, which is potentially fear of inflation, and then you go into gold. Then there's another version of this, which is if interest rates go down, interest-bearing assets are not as attractive, and you can go into hard assets. So these are 2 of the potential explanations people might have for gold. Either way, both of them take an effect.
Exactly. So how about both? The fact of the matter is they're still entertaining interest rate cuts, and maybe even inflation isn't going to re-accelerate in a profound way. That's not what Jeff Rosenberg is saying over at BlackRock. Perhaps it hangs around above target. Sticky.
Tomorrow, a special from Jonathan Farrow on being a gold bug, the one and only.
I think there's some gold bugs out there who are quite happy with that news conference.
100%.
Let's put it that way.
And it's been an incredible rally, and so maybe they've got it just turbocharged.
We'll continue this conversation tomorrow morning. Thank you very much for tuning in to Bloomberg TV and Bloomberg Radio. For our audience worldwide, what a Fed news conference, a green light for so many of you to carry on buying equities. Your stock market at all-time highs. From New York, this is Bloomberg.
of businesses, it is about resilience, it's about pressure, it's about women. Like, so how does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Amman Hotel Group where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. And all those skill sets that they've built, to me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers
Market
now.
on close imbalance, 795 million to the sell side.
This is the countdown to the close. I'm Scarlett Fu.
And I'm Alex Steele. We did it. We made it past the big catalyst of Fed Day. Scarlett, 5,200 on the S&P, record highs for the S&P, record high for equal rated, big move in the NASDAQ, the Russell, totally risk on in the equity market.
Yeah, we got a green light in stocks. We got a green light in bonds, at least on the short end of the yield curve. And Jay Powell had an opportunity to push back against loose financial conditions, and he didn't take the bait.
No, it definitely seems like the dovish interpretation was winning out. But you have to wonder, they took a cut out for 2025, right? And that seems to be sort of skated over. And you have to wonder if that means we're going to have to see a curve steepening because of that. And the dollar also weaker, except for the yen, which we'll get to later on in the show.
Which we'll get to later on.
That was super interesting also.
That is definitely, I mean, yen has been super interesting all week long. But take a listen to the different highlights from what Fed Chair Jay Powell said this afternoon.
We believe that our policy rate is likely at its peak for this tightening cycle, and that if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. Inflation is still too high. Ongoing progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal. We're going to let the data show. I don't think we really know whether this is a bump on the road or something more. We did mark up our growth forecast, and so have many other forecasters. So the economy is performing well. And the inflation data came in a little bit higher as a separate matter, and I think that caused people to write up their inflation.
So let's welcome former Fed Governor and Chair of Wells Fargo, Betsy Duke, as we discuss through what we heard from Fed Chair Jay Powell. Betsy, it's so good to speak with you. There was a lot of confusion, I guess, over the new economic projections because the FOMC revised higher GDP, they revised lower unemployment, they revised higher their inflation forecast, but when it comes to the expectation of rate cuts this year, they kept it at 3. Do you see a disconnect there?
A little bit when you just look at the median of the Fed dots. If you looked at an average of where all of the projections were for rates, you would have seen it move up. And it was a really close call between 2 cuts and 3 cuts. So I did not read it as being as supportive of the 3 cut and the June cut possibility as markets seem to have read it.
The other thing that everyone's focusing on is the fact that Jay Powell was asked about financial conditions. He had an opening to talk down the record rally in stocks, the tight spreads in high yield credit, the record moves in Bitcoin. He didn't take the bait. Is that something we should read into?
I don't read anything into it. I just read it as, he takes financial conditions as they are. I don't think he's reading into it that markets are totally misreading the Fed. But I think maybe, in my opinion, there's an optimistic reading of what was said there.
Yeah, absolutely, Betsy. I mean, that was sort of the takeaway, that it's risk on, but everyone was kind of scratching their heads and being like, but why? We look at 2025. So, Betsy, what do you think the market got wrong, or what do you think the communication was that made the markets get it wrong?
So what I heard is that they still believe that they'll be lowering rates this year, sometime this year. I didn't hear, we think it's coming soon. I didn't hear anything in that direction. So what I paid attention to, a couple of things. One thing that Chairman Powell said was that the recent inflation readings didn't change anybody's opinion that they were on the path to 2%, but didn't give any additional confidence either. So if you were looking for some additional readings since December that would give you confidence that it was going on a certain path, and the last two readings didn't come in at your estimate of that path, it doesn't mean you don't think they're going to, but they haven't yet. So if you were looking for 3 readings that gave you confidence, you haven't gotten any of them yet.
Right,
so
either way.
I think it's going to be very hard to get there by June.
So
I also, I think, assuming that it's possible that by the time you get the next set of projections, it could go either way. The 2 cuts or the 3 cuts could win out. The other thing he said was he talked about the price level being much lower in the second half of 2023 than it was in the first half. And so the comparisons are going to be different. And I think, waiting to see some readings in that against that second half level would make some sense.
Betsy, do you think it's weird that no one's talking about a hike? And I realize that's like verboten and I'm not allowed to say that. But based on the numbers that they have, A, is it weird they're not talking about a hike? And B, would paring back the cuts for this year be in essence a hike?
So I don't think paring back the cuts would be a hike. I don't think that's true. I think there's still a lot to be learned about where the neutral rate is. So if you look at what is the rate, and I think the Fed wants to get to neutral, the rate that's not stimulative and not restrictive.
Yeah.
And right now, the Fed's projection of that, the longer run level for Fed funds is still at 2.5. But you're beginning to see that creep up. And I think if you listen to others who follow monetary policy, there's some discussion that it may actually be significantly higher than that 2.5%. So it's a question of how far are they going to have to go? And if your estimate of the neutral goes up, then you're closer to neutral than you thought you were.
Right.
If that makes sense.
So, Betsy, I'm looking at the market reaction, and banks are the 3rd best performing group if you look at 24 industry groups. And within the KBW Bank Index, all 24 members are up. When Powell says the restrictive stance of Fed policy has been putting downward pressure on inflation and economic activity, let's talk about policy and whether it's restrictive or not for the banking sector. Do you think that's the case?
I don't. I think the banking sector can operate in almost any interest rate environment. So banking can operate with Fed funds rate at 2.5%. They can operate with Fed funds rate at 5%. It's in that transition time that it takes a while for banks to adjust. And that's because they do have fixed rate assets on their balance sheet that don't adjust as quickly. So, but that adjustment is ongoing, has been going for quite now a little over a year, and will continue to go. And so that's what I think the effect is really on the banking system.
Gotcha. Betsy, really appreciate your joining us, as always, on this Fed Day. Betsy Duke is former Fed governor and the former chair of Wells Fargo. So I was noticing, Alex, that Capital One and Amex are still offering high-yield savings accounts with a 4.35% APY. At what point do they start reducing that rate when the Fed signals it's going to actually cut or starts cutting?
But also, if they lower it, it's not going to go to 1 in theory, right? So they lower it a little bit. The same way when they bumped it up a little bit. And also raises the question with money market funds, too, to your point. Is that sticky? Does that stay?
Yes.
Is that just going to get higher rates at the end of day, even unless it goes to like 1 or 0?
Right. Do people necessarily want to move that to stocks like so many people expect? Oh, that's a good question.
Yeah.
All right, we're moving closer to the closing bell. You've got full market coverage right here on Bloomberg as we take you to the bell and beyond.
Beyond the bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
We're about 2 minutes away from the end of the trading day on this Fed day. Scarlett Fu and Alex Steele here with you, counting you down to the closing bell. And here to help us take you beyond the bell with the global simulcast, Carol Massar and Tim Stanovic. Welcome to everyone across Bloomberg Television, radio, and YouTube. Carol, were you confused by what Jay Powell said? And there were various forecasts where they did not move the dots in terms of how many rate cuts there'll be this year?
I'm a little bit confused. I'm also a little bit confused at this market reaction because they bumped up growth estimates, good, but they also bumped up a little bit, right? Inflation expectations for this year. And I just, here we are, a record on the S&P 500 again. It does feel like, all right, maybe the Fed is doing really well at this soft landing, but it's just, I have a lot of questions and I feel like I don't quite get it all.
But they were ever so close to moving the median number of cuts this year, Alex. I mean, they were ever so close to moving that from 3 to 2, and that's what participants noted in the summary of economic projections. So I think we have to keep that in mind that, okay, expectations for rate cuts from the Fed members actually went down a little bit for the year.
Yeah, exactly. And also, if you look at, say, the overall rate, the end rate, right, 2.6%. Yeah, okay, it got up 10 basis points, but it is higher, and that just feeds that narrative of what is neutral higher, and that higher for longer, which again makes the equity rally a little perplexing, Scar.
Well, it's hard to forecast out what's going to happen in 2026 when no one knows what's going to happen in 2 months' time in 2024. Yeah. As Mike McKee was reminding us, for the dots, it's not a collective forecast. It's a collection of individual forecasts. So it's just what individual Fed policymakers were thinking at the time.
At some point.
At some point.
At some point. Oh, yes. Thank you.
At some point this year.
All right, there are the closing bells. We did it. We got through Fed Day. Volume relatively okay, holding up a little bit here, and it is definitely green on the screen. You're looking at a record for the S&P, a record for the equal weighted index. NASDAQ 100 up over 1%. Really big moves on solid volume, Carol.
Yeah, pretty impressive, right? Like, who'd have thunk in terms of this Fed meeting and what we got. But there you have it, folks. If I look at the S&P 500, guys, most names in the index actually gaining ground today. 377 to the upside, 123 losing ground. Scarlett, 3 unchanged.
And that is reflected in the sectors as well. You look at the IMAP, a lot of green on that screen, 11 sectors, 2 of them in the red, healthcare and energy, the rest in the green. In fact, you've got 5 groups gaining at least 1%. Consumer discretionary, communication services, financials, industrials, and tech.
All right, guys, let me get to some of the individual gainers. Chipotle Mexican Grill, man, definitely on my list. At its highs today, up 8%, finishing the day with about a 3.5% gain. Among some of the biggest movers to the upside in the S&P 500, I do believe that is at a record high close. Company proposed a 50-to-1 stock split to broaden the company's investor base after a 13,000% run up in the stock since its IPO. The split would be the first in the company's 30-year history. Went public back in January of 2006 at $22 a share. The stock is now $2,895 a share. So, yeah, that's kind of some big news. Also, to a name that was among the...
Still more expensive than a burrito.
It is.
A share of Chipotle.
You could buy several burritos.
Yeah, even if you divide by 50 right now, it's still more expensive than a burrito.
Yeah, exactly.
Okay.
All right, good to know.
Sorry.
Hey, one of the biggest gainers in the NASDAQ 100 today, ticker is TTD. Trade Desk, $40 billion market cap, advertising technology company. I don't talk about it a lot, but thank you, Disney. They said it would sell ads through Google and the Trade Desk, and so that got that stock popping in today's session, up about 4.5%. We do have some earnings, though.
We do. Micron, the chip maker, has come out with results, and it feels a little bit off cycle given most of tech has reported, but we can tell you that second quarter adjusted EPS was 42 cents a share. The consensus estimate seems to have been a loss of 24 cents. So I don't know if we're comparing like with like. Yeah, so we'll get back to you on that one. But adjusted revenue for the quarter, $5.82 billion. That looks like it's